Good, I just got the class. No, I take 5 days. That's fine.
Yeah, Monday. How's it going? It's good. Yeah. A lot of info, but yeah, it's good.
Is it kind of like a typical onboarding or kind of like?
Yeah, they you don't have access to anything on the first day, so going through that. Yeah, it's nice. Cool. You start August, right?
Yeah.
I'm alive.
How was the weekend?
I don't do anything.
Me neither. I should have brought up my first linear algebra midterm. Imagine that, a midterm 10 days. 10 days. Dude, I'm so good.
I got one tomorrow too.
What's up?
I got one tomorrow too.
Yeah. What class?
Legal and ethical issues and financial management, whatever it is.
Who teaches that? Is it Prelli?
What?
John Prelli?
I don't know what his name is.
Legal and ethical. That's how you put it. Two things.
It's guy. He's actually from.
Yeah.
He grew up in Connecticut, but he's working down in Texas now.
Oh, he's teaching it from Texas?
Yeah.
Okay, then it's not John Prelli. Because he's here. Dude, I don't know if it's me, but like, why? I guess it's mandatory for colleges to have a degree, a course in ethical.
Most majors will have it nowadays.
It's kind of
It's part of the accreditation requirement.
right. I was gonna say people are not like no offense, but like if it's not required, I'm not taking. I'm not taking it. Why would I take it? Maybe that's just me though.
Maybe multiple choice, read questions and all.
Stephen Arian is his name. He went to Quinnipiac for his law school.
Okay. Legal and ethical issues. So what have you learned so far? Kind of the same kind of going of
Securities
Steel.
and Exchange Act 33 and 34.
Good stuff.
Court systems, which I already knew.
Hey, I got some chips if you want. I'm not eating them, but
Nah. Can't eat yet.
what's the saying? Mouth eyes are bigger than your stomach. My eyes are bigger than everything.
I try to go at least 16 hours a day without calories.
Well, I don't.
That's intermittent fasting.
Don't do that. I try to go 16 hours without
Is that
naps.
Windows or a Mac laptop?
This Windows.
Does it hook up to Windows Yukon Secure?
No, I go to Yukon Guest. The secure doesn't work.
Because after the last security update, Yukon Secure isn't working at neither one of mine.
I go Guest every time because it works. I haven't. Once it works, I don't try. Because I'm not like. I guess I should use secure, but.
You get more speed, but
Oh, do you?
Yeah.
I'm not. It works kind of fine so far. I haven't seen a noticeable difference.
I think I gotta do Windows updates, so.
Okay, now, so I'm working on now linear independence, and I still have a bunch of other topics. Like I still have to do linear transformations, matrix of linear transformations, matrix operations and inverses, and then the inverse of a matrix. All right, so it's not looking too good. And characterizations of invertible matrices. All by tomorrow. It's not looking too good, bro.
Yeah, that's a good.
Yeah.
Yeah, yeah. That's very true. I have a problem. I use the Bible for Bible
That's good. Well, did I show you my calculator last time? I did, right?
Yeah, then you looked at mine and said you're gonna buy it for Christmas.
Yeah, there it is. I think I might do it. I looked it up, bro. Dude, that's like a phone. So you can't text people. Well, sure you could if you could like configure it.
It probably has more processing. Well, it may not than your phone, not with the Apple stuff. But
Dude, that's scary. Okay. Like if I showed my grandma that, legitimately, she would think it's a phone. Seriously, she'd be like, "What kind of phone is this?" There's the new one.
Good, how are you? Oh, yeah?
Trying to make a lot of money, bro. Trying to get rich.
Okay.
Make some
Oh, yeah.
cash.
Yeah.
Get some blocks. And go to Colombia.
Did they cover cash?
I thought you were going to Peru.
During the whole, or they did
They're
it
taking down there.
Or just in general? Okay.
Dude, I heard Peru is kind of cold. Is that true? Or is it Chile? What's like the southern?
That's Chile.
Chile, right?
The mountains go right along. Actually, separate it and Argentina.
Is that close to Peru though? I thought Peru was kind of south.
Now Peru is right around the equator.
Oh really?
Yeah.
Wow. Okay. Thank God I'm not doing Peru.
still playing that. You gotta hit traffic going home probably.
No, I haven't hit it last time. Well, no, I haven't hit it last time because I was in at 9. The other thing is, tomorrow's at 7 p.m. So
Yeah, keep coming up this way.
I got the whole day. So, like, I'm familiar because I took this Matt Econ last semester. So, like, or 2 semesters ago. So, I like the matrix operations and like the determinants. And I'm kind of familiar. I have to brush up on that. I should get that within an hour and really be beginner. Less than an hour. But like the theory, focus on algebra is all fucking theory. I've had more definitions in this past week than I've had in the whole 2 semesters here. Straight up definitions. Like, look.
What are you using for a book for this class? Did you find that online?
For which one?
This one.
I don't have it. Oh, but I bought it. It's the option.
The derivative.
Yeah. But I bought it. Yeah, I have it in person. I bought it on Amazon because I need to read it. Otherwise, my eyes get shot. Vision Frontier. I haven't heard that song. So, math. Linear algebra. Oh no. Ability. Courses. Alright, man. So this is the practice. Let me actually download this. Might take a minute if that's slower, but. So question 2, something like not too bad. Just reduce echelon form, okay. Question 1, I'll do some computation, fine. Or question 3, question 4, transformation. Okay. Now read this one, bro. Read 6.
Yeah, you got a lot bigger.
What do you want to do?
I can't see stuff that small.
Oh, sorry. Where the fuck did buy over 2 ratings? I think that's good. What's going on?
We're just talking about 80, 180, pi over 2.
I would choose 90. It's,
Yeah.
yeah.
So just saying you're flipping it. This is being math geek.
I don't fucking know. Well, the guy who teaches this got his PhD in combinatorics from MIT. You should see him. He looks like he got his PhD from MIT, this guy. Nice guy, though. Sweetheart, but like, Jesus Christ. Oh, wow. That's good.
Okay, so the volatility smile and volatility surface are one of the primary topics of this semester. It's one of the more interesting features of options trading that creates a lot of opportunities and value, and also helps to understand the nature of market dynamics beyond the geometric variety of motion and the assumption of global distribution. You know, there are many areas of this industry where volatility comes into play, probably every place, I guess. It's not maybe, it can be, it's not maybe the central part of, let's say, asset management, where the goal is to pick stocks that will do better than other stocks, and explore and try to determine set smart investments, longs and shorts, or understand portfolio theory so that you can assemble a portfolio of good ideas into a good risk-weighted portfolio. Volatility is in there. Correlation is probably more important, in that context. But it does come up, it's in the denominator of the Sharpe ratio, of course. So excess return divided by volatility of returns is is like the most popular metric for evaluating how good a hedge fund is, absent of, say, mean return. Mean return is important, but excuse me. But if you have a good Sharpe ratio, you can deploy leverage to boost the return. And, be a corresponding increase in volatility, but you can optimize if you're looking to make your Sharpe ratio as strong as possible. Lots of ideas that are traded by hedge funds, famous hedge funds, really are ideas that have maybe small edge, but are reliably positive, and therefore you can lever them. But in the options market, volatility smile is everything, both regular options and exotic options, because understanding why the Black-Scholes model, which in this case we'll call the simple model, which is volatility as a constant number for whatever asset you're trading, is inadequate for trading the options market, really goes back to the history of markets. It was by 1987 when the S&P, when the Dow Jones was famous, whatever U.S. stock market crashed by 20% in one day, probably the largest equity crash in U.S. history, I think. It became understood that downside protection was more important maybe than upside protection, and that it didn't make sense to price options on puts the same as options on calls. And we'll talk about that when we look at the equity smile, which is going to come up here. So today we'll more focus on the smile, and we'll also do some work on surface. Volatility surface modeling is a crucial component, especially of exotic option trading, where path dependency comes into play. Path dependency means that not only is the final destination important, where is the European option in the money or out of the money, but the path that it takes there. We'll learn about barrier options, where if you hit the barrier, either the option disappears or comes into existence, or binary options where hitting a barrier yields a cash payout. And for those options, the evolution of volatility is going to be as important as the terminal volatility. American options are, I guess we'll probably call them weakly path dependent, because in many contexts there isn't that much difference between an American option and a European option in terms of price. You may have seen arguments in the last semester explaining that American option on a call option on a asset that pays no dividend, the European and the American options are the same. The main reason to call for the asset early would be to get the dividend. Like if Apple's going to pay a $2 dividend tomorrow, and my option expires on Friday, it's very well possible that exercising tomorrow, thereby owning the stock during the ex-dividend period, is worth $2, right? It might be worth more than the time value of the option. Or if you think of it this way, let's say Apple is trading at 200 and you have an option at 100. Right? There's essentially no question that you're going to exercise that option, because it's $100 in the money, and Apple is not going to fall by 50% in one day, right? So you're going to exercise. Well, if you had a choice between Thursday and Friday, or Thursday tomorrow and Friday next week, if that's your option expiry, it's almost certain that you're going to want to grab those $2 by calling for the Apple stock and being the registered owner of the shares on dividend day. You know how dividends work, right? Company announces a dividend, usually pretty regularly. Quarterly is most commonly, say, in the US. Not every company has dividends, but many do. And whoever owns the shares on the ex-dividend date is entitled to the dividend. So I might own the shares tomorrow, and I'll get the dividend, and if I sell the shares on Friday, it doesn't matter. Dividend won't pay tomorrow, the dividend will pay like next week or a couple of weeks later. but I would have been the owner on the dividend date, so I get the dividend. And what will happen in the stock market is, all other things being equal, Apple's at 100 right now, and 5 o'clock comes, and now the owners of the shares get the dividend. The stock will open tomorrow at $98 because those $2 were gone. Everybody who was buying at 100 was thinking, I'm gonna get a $2 dividend. So all other things being equal, the price should be now 98. And, you know, it will roughly be priced. Now, obviously, between 5 o'clock tonight and 8:30 tomorrow morning, lots of things will happen. The stock market will move around, and Apple will do its own thing in response to the other things. But the $2 will be gone, and consequently, we would expect that would disappear from the value. So in that case, an American option is more valuable than a European option, because you can say, hey, it's not my expiry date, but give me the shares. I want those $2. But if the option pays no dividend, then the European and the American are worth the same. And there are arguments that discuss this, and they prove it in the book. For put options, it's the other way. What's the deal with a put option? Well, if I put option, I give you the shares. And what do you got to give me? You got to give me the strike. You give me the money. So if interest rates are not zero, which is, you know, when people were thinking about this thing in the 70s, the 80s, the 90s, and beyond, interest rates were never zero or even close, except for, say, Japan. It made sense. There could be scenarios where you'd exercise the option to get the cash. Now, you might not exercise it that soon, but again, you'd have to have a scenario where your Apple is trading at 100 now, and your strike is at 200. So you know you're going to exercise that option. Eventually, you're going to force someone to pay you $200 to take the $100 Apple stock off your hands. So you got $100 of profit, right? And there's a point at which you say, hey, give me the $100 cash, I'm going to put it in the bank at 5%, I'll make money. So there are cases where exercising an American put early makes sense, regardless of dividends, because you're going to get the cash, and the cash usually has value. I think, I've never, haven't thought it through enough, I think if interest rates are zero or negative, certainly, that it may be, maybe it's never optimal to exercise the American option early. But I'm not positive about that. The challenge with American options is there's no closed form solution to the American style option. The reason being that the problem requires that you determine the exercise boundary. How do I know today whether I should exercise my American option or keep going? Because there is typically time value in an option. Let's say, my strike is 100 and Apple's at 110. Well, yeah, there's $10 in the money, but first of all, I can lock in that $10 by doing a delta hedge. By the theory of Black-Scholes, delta hedging should enable me to capture the $10 without losing more money. And there's a chance it will go up. You had a question?
Yeah, I just want to clarify. So for a closed form solution, that just means the answer can be like found out in like a finite number of steps, and then you'll reach to.
Closed form solution means that you give me the inputs, and I can do 10 mathematical calculations, and I get the answer. That's a closed form solution. When you a closed form solution, this it's probably not as important today as it was, say, 30 years ago, because computers are a lot faster. Computers have actually kind of hit their maximum limit now in terms of Moore's law, because 3.7 gigahertz, there's a reason why it doesn't go up anymore. It's because the chips cannot be drawn more nanometers closer, pads on the chip. So I think that's over, although the new thing to do is you buy a lot of computers and parallelize your calculation. This was something computer scientists, Moore's law famously said Gordon Moore was the founder of Intel, the maker of, I guess probably still the largest maker of chips, CPUs in the world, maybe not. I mean, Apple makes a lot, AMD makes a lot. But anyway, he observed over time that every 18 months, the price of a CPU would drop in half, and the computing power of it would double. So you had this exponential thing where you're always getting more and more computing power. Moore's law, exponential computing power at exponentially cheaper prices. But they saw that they're going to hit a point in the future where they would not be able to etch the silicon wafers any finer than a certain number of nanometers. And at that point, we would no longer get faster CPUs. and we are at that point. Okay, so volatility surfaces, right? So what is a smile? Let's start with a picture. It's better than this is the volatility smile. So in some markets you'll see a smile. In other markets you'll see a skew. So skew refers to the fact that puts are preferred over calls, which is this skew, or the other way around, calls are favored over puts. So I call these puts and I call these calls because what we're saying is that these are options that own exercise on the downside. And these over here are options that own exercise on the upside. And although you could have either a put or a call here, so let's say spot's at 100, this is 50, right? You could buy a put or a call at 50. But it doesn't really make sense to buy a call at 50 for the following reason. If I sell you a call at 50, it's already $50 in the money. So obviously I gotta charge you $50 and then whatever extra optionality value is, right? But if I charge you $50, it means you're giving me $50 and now you've got a credit liability to me of $50. I've got a liability, but you've got a credit risk, right? So it doesn't make sense that, you know, this putting a call here is like saying, hey, I'll give you $50, you know, and you know, Black-Scholes model has the risk-free rate of interest in there, so you'll earn the risk-free rate of interest on your money, but you don't want to. You're actually taking a risk. I'm not the U.S. Treasury. I am Morgan Stanley. I'm not that risky, but I am riskier than U.S. Treasuries. We think maybe one day the corporations will become less risky than governments, but you know it's not the case yet. Maybe when our robot overlords take over, maybe they'll figure it out. All right. So anyway. Usually if you buy options that are not at the money, on the downside you buy puts, and on the upside you buy calls. There's nothing that stops you from trading the other one. Someone will certainly sell them to you in the market. If you look at the listing of options that might be available in the stock, you might see both high and low strikes having both puts and calls. But we know through put-call parity that any put can be turned into a call by buying a forward, and any call can be turned into a put by selling a forward, or vice versa. Okay, that's a volatility smile, and that's a skew. Okay, and then the smile is when the premium of implied volatility is more or less the same for both upside options and downside options. Puts here, calls here, both trading above the at-the-money vol. Okay, and we'll talk about why this should be. Well, they'll show us some data. And we'll look at other reasons that are important to understanding the value in downside strikes that imply. You know, if you think of the at-the-money vol as kind of a reasonable representation of the market's forecast of volatility for the next T period of time, then why would we need to use higher volatilities for the outside? The essential reason is the perspective that when we get to one of those edges, which are called the wings, when we get into the wings, something has changed fundamentally about the market, and we only get there because volatility is ultimately higher. We'll see there are other reasons that drive volatility smile and skew. And markets will trade. So what we're learning about, you know, first of all, you know that everybody trades stocks, let's say, or currencies or commodities. People buy and sell based on some set of fundamental or technical reasons that they think the thing they're buying is going to go up and the thing they're selling is going to go down. Well, once options became a tradable instrument, people would buy and sell options based on whether they thought they were going to go up and they were going to go down. And the key to understand, you want to remember, they're not buying call options because many people are not buying call options because they are hoping the stock will go up. Now, of course, if you're like on Wall Street Bets on Reddit or something, there are plenty of people buying options to get leveraged speculation. You could buy, let's say, a NVIDIA put struck at the money for, I don't know, let's just say $500 the day before earnings, and if you're lucky, in one more day it'll be worth $1,000. You double your money, right? Or maybe worth zero because it'll become worthless. But people do use that to obtain an extreme amount of leverage. Whereas if they wanted to make $500 on NVIDIA shares, they could buy 100 shares, maybe it makes $5, that would work for them, right? But then they have to put more capital up, right? You know, leverage essentially means that you put a limited amount of capital up in hope of getting a large return. But as always, you can only have that hope if you're willing to accept the risk on the downside, because if you can make a lot of money easy, you can also lose a lot of money easy. The reason that guarantees this is essentially no arbitrage principle. If there are easy money opportunities, everybody, all these smart people in the room and everywhere on the whole street will be finding them and buying them. And if there's all these easy losing money activities, they'll happily sell them away, right? So those drive the prices to their fair level. Okay, so the common place where foreign currency options are one place where volatility smile is often seen, but this is really only true about pairs that are fairly stable with each other. Euro versus dollar would be the primary example. Sterling versus dollar would be another. British pound. Now fading maybe in global importance, but in the 90s when these things were evolving, famously the British pound was a big part of the thing. And also gave you a chance to speculate in Europe on a currency that was not involved in the euro. Today, the only currency that gives you that is maybe the Swiss franc, not counting the Eastern Europeans, Poland, Czechoslovakia, and Hungary, which are tradable, but the smaller economies, smaller options markets, right? But Swiss franc, famously is somewhat quasi-pegged to the euro because they have such a central interest in the European economy that they try to maintain an exchange rate that is extremely stable, to the point where implied volatility on Swiss franc versus the euro options is often on the order of like 3%, where euro versus the dollar might be 8%, dollar versus Swiss franc would be 10%, dollar versus Brazil 15%, okay, or 18 or 20, dollar versus South African rand, and so on, right? Equity markets, again, your benchmark. Look at the VIX any day, find out what the VIX is trading at, but S&P 500 vols typically in the range between 15 and 25, okay? All right, so that's the implied volatility smile. So we're gonna ask this question: why is it that people will pay more for downside or upside options than they would for at-the-money options? Paying more being in implied volatility terms. We talked about this last week. The European options and American options as well are monotonic in volatility. What that means is if you put a higher vol into the Black-Scholes model, you get a higher price. You put a lower vol and you get a lower price. And what this meant, we drew the XY axis. We said, look, if you have this graph, if you know the volatility, you can find the price. I'm not using these axes. I'm using the axis from last week's drawing. If you know the price, obviously, if you know the vol, you get the price. I'm sorry, that one's easy because you stick it into the Black-Scholes formula, you get the price, right? But the invertibility says that it works backwards. If you know the vol, you get. Sorry, if you know the price, you can get the vol. And many traders, actual option traders, as opposed to say speculators on Reddit, they'll trade implied volatility terms. They'll think in implied volatility terms. They won't say, is NVIDIA option cheap at $17 for 1 year? No, they'll say, well, 1 year NVIDIA is trading at 22 vol. That's pretty high, but there's a lot of uncertainty in the future, so maybe that's reasonable. Or if they think it's too high, they'll sell NVIDIA options to reap the expected premium. And 22 vol means 22% vol standard deviation of returns annualized. We'll review that calculation when I put the pencil up in a few minutes. Just to recall, how do you get historical volatility? You take every price for X period of time, let's just say a year. You take the log of the ratio, which is the log return. You with me on this? Yeah? Is familiar or not familiar? Am I making sense? Mm-hmm. Okay. And then we take the standard deviation of that number. That gives us the standard deviation of daily returns. And to convert it into annualized, you multiply it by what number?
252.
Which is it?
252.
Close.
256.
Well, also close, but you're missing one operation. It's not just a number. Sigma times, not t, but
Square root of t.
square root of t, right? Because variance is what's the geometric Brownian motion, or Brownian motion for that matter. Variance is additive for independent periods, which makes standard deviation proportional to the square root of time. Okay? Yeah, so you multiply by the square root of 252 if you have a calculator handy, or spreadsheet, or Python code, or whatever code. You multiply by 16 if you're doing it in your head, because square root of 256 is 16. It's easier to do than 15.7 or whatever. Square root of 252 is 15.9 probably, right? Okay, that's implied volatility. And then you can read this slide. I sent the slides to you, so this is not that important. It just says why it should be the same for calls and puts. I think a simpler way to say it is that, look, you put the put on, keep the put on the left side in the top line, move spot to the other side, and you can see why I like my F minus K formulation better. It just looks cleaner. And you just see that there's the difference between a call and a put is just a constant. It's a number, right? So if you use different volatilities, you get a price which would be arbitrageable. That's all that slide's really saying. Okay? Oh, so then, oh yeah, I guess, did I skip this one? Yeah, okay. So then, here's what the data tell you. So take a moment. This is a good question for you to think about. What is this picture telling me? And if you've been around for a long time, let's absorb the act. Okay, pink is the implied volatility from the stock, from the market. Blue is the log normal, this volatility, which means the volatility you stick into the Black-Scholes, into the geometric Brownian motion. That's the log normal volatility, right? And it'll be kind of, where does he come up with this? But more to the point, I guess, is not that this is the picture that that comes from graphing implied volatility. What this is really saying is, look, if I take this slide, which shows that there's extra volatility priced into downside and upside options, that what that translates into is there's a calculation which we'll see later in the evening, which enables you to convert this into the market's opinion about the true distribution of daily returns on an asset. And that market opinion is this thing here. And you can see what it says is because it's the implied volatilities say that they think that returns have these fat tails. This is fat tails, okay? And because you have fat tails, we talked about this at some point that, you know, the whole thing has to sum to 1. The area under the curve has to be 1. So that area has to come from somewhere. In this case, it comes from, there's less here and there's actually a little more in the top. You don't really need the pink to rise above the top. You could actually put the pink like at this height here, but then this thing would have to be fatter and weirder inside. So probably, I don't even know if we could draw a smooth curve like that without, you know, breaking some kind of convexity rule, which ultimately is where arbitrage comes in. So this just says, look, the market, this doesn't look that fat, right? You know, what do you mean fat tails? Pretty much the same thing. You might think of it as kind of like a T distribution, except a T distribution, of course, would have the property I said, right? The T distribution would be, I think it would be under the blue line, but the tails would be fatter. So if I pull this tail further out, then this thing will grow a little bit, but this thing will just kind of pull down to a lower thing. So it is certainly possible to grow that. Then they give us some data. So here's the property. Both tails are heavier than the log normal, and it's more peaked than the log normal. And more peaked, what does that mean in terms of the market? Ask yourself this question. What does it mean that there's a lot more mass? Probabilists like to say, call this mass. How much probability distribution is stuck in like a small range, let's say like half a standard deviation to either side of 0. What does it mean that there's more mass in terms of the market? It means a lot of days you're sitting around on your phone trying to like play Wordle or something, or whatever it is you do, chatting with somebody, because nothing's happening, right? On the days when this is what happened, like today was this kind of day in the stock, on these kind of days, nothing's happening. right? The thing is barely moving. And if it's barely moving, like, you know, at the end of the day, there's a good chance that it didn't really move that much the rest of the day, right? So you can keep one eye on the screen and one eye on your lunch or something, whatever it is you do when you're not working. Or maybe you're advancing, you know, humanity with your spare brain cells, which would be good if you're doing that. And we thank you. But then there are these days when it's much crazier than you expected. So that's the trade-off. It's like most of life, right? You get the higher highs, but the result is you have to live through more boredom, right? You know, when you're not going on the roller coaster, it's like, man, this is so boring, right? You know? Okay. And then they give us some data. We'll come back to the explanations and all. And what this data says is, now this table, who knows how long this thing has been in Hull. He probably created this table in like 1997. So who knows what would happen if you ran it on modern data, maybe once in a while when he's getting a new edition. I suspect if we pulled up, this edition's I think, I guess it's 2022, right? If we pulled up an edition from, I don't know, 2012, I'm gonna guess he's got the same table there because Hull's just clipping coupons at this point, right? He sold who knows how many millions of copies of this book. Very smart guy and also quite personal. I met him once or twice at conferences. What is this saying? This is saying in the real world, okay, in a log normal model, 31% of the time we're greater than one standard deviation away. What would it be in the normal world? I guess that's the same thing, right? 68% is clustered in the middle, right? 68.13, right? So adding that up, it's like 68.3 plus 31.7 is 100, right? So I guess it's the same. The log normal, what we're talking about is returns, right? Log normal means that prices, a log of prices is normal, so returns are normal themselves, okay? The final distribution of S that we're projecting onto the future is log normal. That means the return, S at the final time divided by S today, is itself normal. I remember the first time someone was talking about the log normal, one of my teachers, I was like, what does that mean, log normal? He was just saying it like it was something. And I was like, what does it mean? But I'll put it, you know, basically a log normal is E, the exponential, to the power n, where n is a normal distribution. So you take a normal distribution and every realization that it could be, every time it comes out, you stick it on top of the exponential. That's a log normal distribution, which means if you take the log of e to the n, you end up with a normal, okay? So you can see that 31.7 is higher than the real world, 23. 4.5 is a little bit lower than the real world. And this is where it kind of gets interesting. In the real world, you'll see 6 standard deviation moves 0.13% of the time. So 13 days out of 1,000, which is 13 times in 4 years, let's say. So 3 times a year, you see a 6 standard deviation move in whatever foreign currency market he was looking at. Whereas in the real world, you gotta wait like, I don't know, probably like 100 years or 1,000 years to see one of those moves. So you notice the log normal, 31.7, is higher than 23.3. That's the pink is high in the middle. I guess, we'll just do this. A little better, I suppose. Okay, that's the log normal world. And the tails are fat, you know, the 0.13 is certainly bigger than 0. The 0.24 is bigger than 0. So all of this, the chance of getting a greater than 3 standard deviation move, add them all up, we have, looks like about 2. 79, actually a little more than 2. Now what's 3 standard deviations on a currency which is 10 volatility? So kind of a good rule of thumb is you take the, let's make it 8 volatility, right? You take the 8 and you divide by the square root of 256, which is 16, and you get 1/2, right? So a 0.5% move, if volatility of the currency is 8%, 0.5% move is 1 standard deviation, okay? Multiply that by 3, you're talking 1.5%. So multiply it by 6, you're talking about 3%. So, you know, 3 times a year, you get a 3% move in currencies, which is a lot for currencies. For dollar Brazil, where the volatility, let's say, is at least 16, divided by 16, now we're expecting 1% a day for the 1 standard deviation, okay? Actually, I saw something the other day which explained that daily vol is actually more like 0.8 times the number I've been computing, but I'm not going to dwell on that right now because, okay, equity vol. This is a well-known phenomenon that downside options are more expensive than upside options. Okay, what that means in practice, if the S&P 500 options are trading at 15 vol or 20 vol for the at-the-money strike, the downside strike, let's say 80% strike, 20% drop in the market, will be trading significantly higher, maybe 24, 25, 26 vol. The question will be why? Why is this the case? If you had to, this is a good question for an interview, right? All these, I try to make all the questions I ask be ones that would be good questions for interviews. Why is there a skew in equity applied, equity vol, equity implied vols, equity option implied vols? Why is there a skew? 3 reasons immediately come to mind. The most sensible one, in my mind, is supply and demand. That's the first one. Everybody, quote unquote, everybody is long equity. Why? Because they're in a pension fund, or they have a 401k, or they have whatever assets they have managed to accumulate in their lives. They've put some of it into the stock market. And unless there's some kind of aggressive trader who's going short the stock market, they're probably long the stock market, right? So everybody owns options, everybody owns equity. So everybody needs the same protection. Everybody needs downside protection. So that means that all other things being equal, I want to buy downside protection. So what happens when a lot of people want to buy something? Prices go up. So right there, even if there was no difference between the behavior of the markets on the upside and the downside, immediately supply and demand would just say, I should probably charge more for puts because people will pay more, right? They won't pay me that. You don't have to pay me that much for calls. Now, the second thing that comes in is the distribution of the market. Nobody is worried about the fact that they might wake up tomorrow and find their stock portfolio was up 20%. Nobody goes to sleep at night, like, oh, what am I going to do if I make another $200,000 tomorrow? So I've got $1 million portfolio. Now, I don't know how I'll survive, right? No, but they are worried about, you know, if the stock market were to drop 20%, not tomorrow, but let's say in the next 90 days, if we don't get 90 deals, right? Then maybe I can't retire next year or 3 years from now, right? You know, it depends on what your window is, right? But you're worried that things could happen, and you want to buy protection, right? So you're worried about that. And in fact, reality says the other reason why you're not worried about the stock market going up 20% by tomorrow is because that never happens. It's not just that it's not that you wouldn't be happy. Of course you'd be happy if you have a 401k, but you're like, it never happens. If I make money in a 401k, I'm lucky in a great year, I get 20%. You know, 20% years don't happen that often. The average of the U.S. equity markets going back to 1925 is like 7%. Maybe it's 7% over inflation, which would then be 9%. But I forget, you know, that's not my specialty, right? But it's something like 7%. I buy the indices and I just let my money grow and hope, you know, it doesn't drop by 20% the day before I retire. Or the day after I retire, worse, I guess. Now, of course, I should be diversifying, right, from retiring. But nobody's ever seen this. Well, it did go up 10%, right after one week after Liberation Day, because all of a sudden tariffs were on pause. It was like an intense rally. True conversation, right? You know, keep your money in the market unless you like are really have a crystal ball, in which case, call me up and you get a signal from the crystal ball, and I'll join you in the investment. But they have seen it go down. They've seen it go down a lot. 1987 I mentioned, 2000 in the US when the NASDAQ crashed and everything else crashed. 2008, another big crash. There have been other, 2015 I think was a big down year, like 20%. In Biden administration, 2022, I think the equity markets were down 20%. 23 and 24, they were pretty good. They made like 20%. But that's the nature of the thing. They do go down sometimes, but on average, if you put your money in the stock market, you at least, if you're in the time machine, born in 1940 or 50, you're like, hey, this thing's just going to keep going up, right? We don't know what's going to happen in the future, and it's good to keep that in mind. You may need more than you realize, but that's a crystal ball, so I'm not going to worry about that. So they are worried. They do know it can go down. So so two factors. They supply and demand says I need protection on the downside. The second thing is we observe bigger downside moves than we see upside moves. That's an actual skew in the distribution. Normal distribution is not skewed. It's perfectly symmetrical on both sides. But the real distribution has a third moment. So the moments of a distribution are the mean, which is the first moment, the standard deviation, the volatility, the variance, I should say, which is the second moment. The skew, which is the third moment, that's the, throw the picture here, let's get the actual returns. You can see the skew here. This tail is fatter than this tail. That's skew, okay? And then the fourth moment is the tails in general. This one definitely has a fourth moment. The fourth moment is kind of like the variance squared in a way, okay? And these have, concrete, just like standard deviation has a concrete mathematical definition, so does skew and kurtosis. So the fourth moment is, the fourth moment refers to the kurtosis. It's called the kurtosis. So you have mean, variance, skew, and kurtosis, or skewness sometimes. And excess kurtosis is when the tails are fat. Now, the equity distribution has this, this tail is also kind of fat. This one's kind of not so fat. So it may or may not have some kurtosis. When we say excess kurtosis, that deals with the fact that for the normal distribution, the standard normal distribution, the mean is 0, the variance is 1, the skewness is 0. It's not symmetric, it's not asymmetric at all. But the kurtosis is 3 for normal distribution. So when we say excess kurtosis, we're saying it's got more than 3. It's got tails that are fat. T distribution would be your example. It's got tails that are fatter than the normal distribution. By what we've already talked about, by the way, all of the odd moments of the normal distribution is 0. The mean is 0, the skew is 0, the fifth moment, and so on is 0. But all of the higher moments that are even are not. Okay, so that's our distribution. So here's one other reason. So we talked about crashophobia. That's the one where we say, that's kind of, this isn't even supply and demand. It's kind of funny, you didn't really talk about supply and demand. But it's kind of baked in. The fear that the market will crash. If you didn't own equity, you wouldn't worry that much about does the stock market crash. I mean, if nobody owned equity, so to speak, right? Who cares if it crashes? It's just a number, right? But of course, even if you don't own the stock market, you worry about crashes because crashes are often accompanied by bad economies. And even if you don't have equity, a bad economy is bad for you. There's less money going around. So that's kind of related to crashophobia. The so-called volatility feedback, it's kind of also implied in the equity, in the foreign exchange. I'm going to go back over here for a second. Yeah, this one here. So the two possible causes for volatility smile in foreign currencies, both of these actually also apply to the equity skew, which is that exchange rate exhibit jumps rather than continuous changes. I would argue that probably stock markets are more likely to jump than equities. People understood, even in the 1970s, that markets are not necessarily continuous, which is a supposition of the Black-Scholes model. Robert Merton, who also got the Nobel Prize when it was awarded for this model, he created another model called the jump diffusion, which looked like the Black-Scholes model, but then had an extra term at the end representing a jump. Now what a jump means is, once in a blue moon, we'll define blue moon in a second, once in a blue moon, the stock market moves 10%. Something that will not happen even with skew, but once in a million years on the geometric Brownian motion. We're talking 10 standard deviations, let's say. 1987, like I say, stock market jumped 22% in one day. The probability of that happening in a normal distribution, it's like, it's probably at least a 10 standard deviation move. You can put that into your calculator, norm of -10, and you'll get some number that has more zeros than the computer will show you probably, okay? But, so, it's recognized, well, that wasn't a continuous move. It didn't just kind of mosey there really fast. It really just, it jumped. It's a different model. And the problem with the jump model is it's very hard to estimate, because jumps only happen once every, real jumps of the size of 1987 have only happened like twice maybe, right? So how do you, what are you going to put in for next year's jump probability? It's a pretty low model. Second possibility, exchange rates are stochastic. The volatility of exchange rates are stochastic. This is an interesting question which is studied heavily in the 1980s, led to a couple of models about the fact that not only is spot, the price of the asset, volatile, but the volatility itself is a second random factor. And I think this is a good time to, well, I'll put that up I'll draw a picture of that, but we're really saying that there's two factors. We have the one model, which is, ds equals USDT plus sigma SDZ. But the second factor says d sigma itself is a thing. There's a process for sigma, and one of the implications of that is that you can get volatility surfaces which look like, volatility smiles which look like the ones we've seen for both equities and foreign exchange. The last explanation, this is a common explanation, which I kind of like. It's also the kind of hypothesis that finance professors, I'm not a finance professor, right? I'm a mathematician, but someone like, Dr. Schnoy or someone might have, Professor Schnoy might have studied, is the so-called leverage effect. This may be already studied out by now, I don't know. But leverage effect says the following. When equity price, this was first postulated also by Robert Merton. Robert Merton was really, he's still alive, he's really smart. He came up with a lot of very interesting papers in the 70s and the 80s, and his name is on a lot of finance for that reason. The leverage effect says, look, what happens is when the equity of a company goes down, so you have Apple, let's pick Tesla, good example. Tesla now, equity value is probably like 800 billion, maybe it's back up to trillions. It's had a good week or so, right? Elon apologized to the president. We didn't apologize, but he said, I was wrong. And his stock price is increasing, but it's at 1 trillion, right? But what happens if Tesla's stock price gets cut in half? Something which has happened, right? Or almost happened. Now it's 500 billion. So now what you have is the debt to equity ratio has changed. Tesla, I don't know what their debt position looks like, but your debt is supported by your equity. Now there's two kinds of ways of thinking about equity. One is actual money that's been paid into the company plus retained earnings, that's equity, right? But the second concept of equity is if the stock market, if the value of my shares have been going up, it's a form of implied equity because I can always issue more shares at that high price. So there's a demand for my price, and I can sell shares. And the leverage effect says that if the price of the stock decreases, it's got less implied equity essentially, which means debt to equity ratios are higher. What does that mean? You've been in finance classes now for, at least a year here. Probably many of you had a finance class before you came here. What's the importance of the debt to equity ratio? Is a company riskier when the debt to equity ratio is high or when it's low?
Hi.
When it's high, right? Because debt is high, the numerator is high, equity is low. Either way, high means you borrowed a lot of money in the hopes that you're going to get a supersized return. People like debt for this reason, right? Some of the biggest users of debt in the financial universe are people who drill for oil or they drill for gas. Their goal is to put up like, $10 million and then borrow $40 million at, let's say, 10%. So now they got $50 million to play with, and they're hoping that that $50 million will make 20%, let's say. So 20% on 50 is $10 million, and they borrowed 40, their interest rate is 10, they have to pay back 4, so they got 16 in profit, and they only invested 10, you got 110, whatever that is, 16 over 10, 160% return. That's what leverage is, right? People like that. And banks are happy to lend money to you. Hedge funds all the time. You see something like XYZ hedge fund made, 37% last year. Like, wow, how'd they make 37%? The stock market was only up 15%. Well, the answer is, more likely than not, they borrowed 2.5 times their capital base and put it all in the stock market and created some fancy marketing slides that say, we're not just beta, we're alpha too. But yeah, I'm sure they are. I mean, they definitely are. The long-term winners undoubtedly are discovering things that other people cannot discover. But even them, they're leveraging that up as much as they can take, right? When long-term capital management, you know about long-term capital management, right? When Robert Merton was there, and Myron Scholes, they were both partners in this firm. And I think I recommended that book to you maybe in the fall. It's a great book, When Genius Fails. In the first half of the book, they're just like getting richer and richer and richer for like the 3 or 4 years. And the second half of the book, they get less rich, and it happens really fast, like a week. And but it's because of leverage. And like the thing is that their leverage ratio when they went under was like 33 to 1. So some year they made like 40%, but their leverage was 33 to 1, which means they found an edge of like 1.5%, and they levered it up 33 times, and then they made 40%. Hey, we're geniuses, right? And we have sophisticated risk management controls in place, and I don't doubt that they did. They were all very smart guys, or there were probably some women there too at the time. It was still coming out of Solomon Brothers. There probably weren't that many, but all the principles in the book are men. That's why I say guys. But they undoubtedly had a really sophisticated view of the market, but they got over their skis. That's what they call it, getting over your skis. You ever see the people who jump on the mountain off the big ramp? If they get over the skis, that means they're probably going to fall. I mean, they get a little bit over your skis, but they got too far over their skis. So that's leverage effect. So these are the 3 things. Volatility feedback just says that when the world starts getting crazy, then it gets crazier. That's the feedback loop, which could be kind of incorporated into stochastic volatility. Okay, let's see where we are. We'll talk about this in more generality in the future. It's pretty common in many contexts to, when you speak about what the implied volatility is, speak about it in terms of the delta of the option. Some people will plot implied volatility against the moneyness. K over F for a call is the moneyness, right? If the strike is 100 and the forward is 150, that's actually backwards. I think it should really be F over K. I don't know why he says this, because if the strike is 100, you want the forward to be 150, because the forward is where you're going, right? That's the at the money, so to speak. So if your strike is 100, you're in the money, and the forward over that is, anyway, doesn't really matter the way you graph it either way. Maybe this one, maybe I'm wrong, maybe this one puts upside calls. I'll have to think about that. I think this, I gotta think about it. But anyway, more common to plot the volatility against the option. Now, if you look at the formula for delta, which contains the log of F over K, right? So delta has baked into it the log of F over K, which is essentially the amount of return you need in order for this option to go into the money. And we'll draw some pictures. It's common to refer to the at-the-money option as the 50 delta option, even though it won't be exactly 50. It'll be like 52 for a call and 48 for a put. If you've got your formulas together, we'll be able to talk about these later. Okay. And then finally, term structure. Okay, let's bring up the computer. Let's bring up the code now. So I did a new version of the code. If you've already completed the homework against the old version, it's fine. Completing the homework means you can pass the tests. Obviously, you can ask GPT to do it for you, but you wouldn't learn as much that way. And it does make mistakes. Let's see here. Oh yeah, I gotta download the homework myself. Okay, let me just get a second to put this together. Okay, so I made one change to the test file. I want to point it out to you because it's worth discussing, which is I changed the the answer to theta. And I changed, these numbers were positive, I changed them to negative because I realized in my solution, I had implemented the formula incorrectly. We'll discuss that in a second when we look at the suggested ways to compute these formulas. Theta for European option is almost always negative, and American options too. And what that means is, what you want to represent is the fact that if I own an option, I want to show on the screen my theta is negative, which is reminding me that tomorrow this thing will be worth less. Sometimes people say theta is a wasting asset, which means it's disappearing. It's an old, sounds like it was written in 1500 or so. Some people say the same thing about youth or beauty, also wasting assets. So, do with that what you will, but they both should be negative. And I noticed they were positive, and I looked at my solution. I realized, of course, what had happened, and we'll look at that now. Before I go to the file, kind of, you can do both, I suppose, but bring up the homework assignment as I've written it. So I just tell you that in order to pass the tests, which is the goal here, it says use the standard formulas. Be sure that your formulas will work when R and Q are not 0. Now, all of the tests that I gave, I assumed R and Q were 0 because, like I told you, ChatGPT was getting it wrong when they were not 0. I didn't figure out what the issue was. I think it gave me good code, but it didn't give me good answers because the answers it gave me in my test file did not match the answers it gave the code that they were generating. But I looked at the code, I didn't see any mistakes. So you use the D1 formula, D2 formula, and you also do call, put, and delta using ND1, except that this is where the R is important because delta is not ND1, it's e to the minus RT, or no, e to the minus QT times ND1. If you have to buy 100 shares of a stock to hedge yourself, but that stock is going to pay dividends, then you buy a little bit less than 100 shares because you roll the dividend up into more stock, okay? And then I tell you now, for other Greeks, gamma tends to be less interesting in general. People that I've worked with in the past, they don't actually look at how much gamma they have. Well, maybe they do, but what they do instead is they compute delta at a variety of spot levels. So let's say, spot is 100. So they say, well, my delta is, let's just say my delta is 50. And at 110, maybe my delta is 70, if it's a call option. So as spot goes up, the delta is going to become more. That gives the trader an idea how much re-hedging they're going to have to do so they can anticipate. Do I want to buy shares in advance of it, right? But this is what's called, so use the finite difference calculation. We'll do this on paper after the break is over. This says compute delta with spot 1% up and 1% down. You could easily do 0.5% either way, but I said use 1%. If you don't do that, you won't match the test. You won't know if you got it right. If you do it the way I tell you to do, then when you run the test, they'll all pass. Subtract the delta results. So you take the delta when it's up, minus the delta when it's down. So if it's like 60 delta when it's up, 50 delta when it's down, right? So that means the delta's moved by 10 over the move, and then divide by 2 times ds. I wonder if we really should be dividing by ds. I think it probably should not be dividing by ds. I'll have to double check that. I think maybe we only divide by 2. Well, I guess from the point of view of calculus, this says take the delta at spot plus 1% of spot. It's moved the spot up by 1%, not by 0.01, and move it down by 1%. So you've moved this is remember, deltas are just delta y over delta x. It's just the same slope calculation you learned in Algebra 1 class. How much does the numerator change, divided by how much is the denominator? That's the derivative. That's the slope. For gamma is the derivative of delta, which is the derivative of price. It's the second derivative of price. But so you're subtracting spot up minus spot down deltas, so we do want to divide by 2ds. That should work out correct. And more interesting calculation, and I actually made a mistake here. I'll do it. To compute Vega, the way it's often done is, you could use the closed form solution, first of all. The closed form for Vega is good. But what happens is when options become more complicated than Black-Scholes, it's more robust in code to just bump sigma by 1% up and 1% down and recompute the two numbers. And it will look basically like the Vega you get from the closed form solution, but for exotic options, it'll be a lot easier to just do this. The finite difference just means make small changes in the parameter that you are stressing, in this case vol, and then divide by the ratio. And this says divide by 2 sigma, but this should actually say, and then divide by 100 after that. We talked about this last week. We don't really want the Vega for a 1. We don't want to know how much price changes if you move vol by 1, because 1 is, it's 100%, right? And vol doesn't move by 100%. 1 whole is 1.00, but that's 100%. Vol doesn't go from being 20 to being 120. We don't care about that. So they move vols by 1%. Maybe we don't need to divide by 100. We'll take a look at that later. It's a good question. There's a little bit of uncertainty here. Now, the way to compute theta, a common way to compute theta is to just roll the calendar on your computer by 1 day forward, conceptually. So value everything in your portfolio today, and then say, now make T 1 day closer to the future, and revalue the whole thing. And take the new number, which is where you're going to be tomorrow, minus the old number where you are today, and that's called the time decay or the theta. So this just tells you, move it by making time smaller, because time doesn't get longer, right? You don't get more time. You don't wake up tomorrow and you got 1 extra day to live, as it were. I mean, maybe you have the same number. Maybe it's a, what's that process? A Markovian process. Or it's a memoryless process. You'll study that next semester in your credit class. And then finally do the same. Interest rates typically, I think it's common for, I've never been a full-time interest rate person, but I think it's common for them to actually only bump it down. But I said move it up, move it down, and then divide by 2 times dr. So try that out, and if you get stuck on it, you can send me a question and say, look, I think I did what you said, and it didn't work. So what am I doing wrong, or what did you do wrong? Because sometimes I make mistakes, right? Let's look at how I changed the code. So I just, I fixed the code a little bit, and I made some changes. Like I put in a compute forward price function. Let me just make this a little bit smaller. I put in a compute forward price function. You don't necessarily have to do that. I like using the forward, and it's just generally speaking good. One thing you might notice, if you're observant, let me just shrink this for a second. You can see that my forward price function is not part of the Black-Scholes class. It's something else. So I just leave it like that. I don't define it in the class, which means it has access. If you're in the class, you can access all the variables in the class just by using the word self. But it's not in the class, and that's just the way I did it. Okay. And then I said, I had GPT. I said, give me nice comments. And this is a good way to write your code, right? Even if you write code, like if I had to do this by hand, I just wouldn't do it because A, it's just a homework assignment, and B, you got to get on with life, right? But even if I were writing this for a professional code base, I might assume that most of S, R, Q, and T are known, and I might just not bother to annotate it. If I were working for someone else, I might say, you need to leave comments here. There's how much comments is. I was on a phone call with a couple of guys at work today, and he was somebody said, could you explain to us what this part of the code does? He said, well, maybe I'll put comments in as we go along, since I'm explaining it. But he started to type the first comment, says, yeah, but this part is so obvious, I'm not going to comment it. And so it is. One of the things when you learn good coding, it says try to use names that are descriptive. Now, some people might prefer SPOT for S and T, time to maturity, but you know, I look at math books all the time, it's always S, it's always T. I'm not worried about it, but you know, that's the thing. But you know, I wrote a little function down here, just F equals, etc. to get the formula. GPT gave me all the stuff in green. It says, this is what I'm doing, and it looks nice, right? You know, somebody can read your code base and say, and you can shrink the comments. You know, actually, yeah, so you can shrink all the comments down. And then after I had my code working, all my tests were still working, I took all of the actual formulas out. I just put return none, because that's, you gotta put something there, okay? You can compute the forward yourself and then return the forward, or you can just put the formula for the forward right there, because this is pretty simple. Okay, Black-Scholes, it's a class. You know, I didn't tell it any of this, I just told it, I guess I gave it the code, probably had the class Black-Scholes, had the methods, but it said, okay, this is what it's doing, and it tells you what Black-Scholes is, and it also tells you that it handles options on assets with continuous dividend yield. So, you know, something's going on in that computer that it's able to tell that's what I'm doing. You know, all I gave it was the Black-Scholes formula. The init method, init, as I said, is it's called the constructor in computer science. Every class will have a constructor, and you know this is what makes a class a class. I guess you can't. Well, you have the code too, right? A class is a factory, if you would, for building objects, right? And what you want is when you want to use the class, the first thing you say is, hey, give me an instance of that object. Give me one. You know, you tell me you make Black-Scholes options, give me one of those. You call and when you say, give me one of those, which we'll see, for example, over here. Here we called it the model. It actually would make more sense to call this the options. So let me just go and right-click, refactor, rename. Remember, I told you that you want to do this so that everything gets renamed, not just the one instance. Call this the option, right? Okay. So the option that's going to be tested is, and this says call Black-Scholes and pass this information to it. And you know, where's that Black-Scholes coming from? You can see it's up here. It's coming from, not from Black-Scholes solution in this case, but from Black-Scholes. Okay? And that's that, right? And so when you call, when this is how you access the class, you say, give me one of these, and you may or may not pass arguments depending on what you want. In our case, since we didn't provide any default arguments in our constructor, you have to give them all, otherwise it will complain. Okay? And all the constructor often does, the first thing the constructor will do is it'll take all the variables that the object itself needs and define them. And by using the word self, it says, I'm going to attach this value of S to the object that's being returned. And then I give a bunch of calculations that I think you should do here, but you don't have to. It's a give me an e to the minus, it's telling you what it wants, right? E to the minus RT. But I gave you none here, okay? This is more about you getting kind of comfortable in the environment for computing. Compute your forward, and that's your constructor. And then D1 and D2, it tells you the formulas for D1 and D2, or you look them up. And I'm just setting to none here, but you can get them, okay? And then, you know, that's it. The call price, you know what that looks like. The put price now, and the delta, all three of those you can do using just the stuff right out of the book. But for gamma, and you can see I gave you the hint on the gamma, move spot by 1%, okay? So since you are moving spot by 1%, you do want to return delta up minus delta down divided by ds. That's really, you know, that's delta y over delta x, okay? And then the Vega, as I told you, use, now notice it's not 1% of the vol, it's just 1%. And it'll be kind of interesting whether, I guess dividing by 2 d sigma will just be divided by 0.02. I think that will actually work. Because you could then change this to be 0.005 and it would still work. It might not give you the right answer for for the test, but it would actually be a good, a valid use. Here's your DT, okay, and then there's your row, and that's it. And you should be able to pass all these tests. It's a good exercise, like I said, it's very satisfying to run the tests, they all work. Or if they don't work, you go and debug and say, what am I missing, why am I getting this wrong? And you go look at your code. Okay, let's take a break. And you can ask questions during the break or after the break.
Zero over any number, any rational number, any real number outside zero is zero. Just double check.
Zero is not two.
Why though? Why? Why is, because any number, any real divided by zero is.
Because you don't know what the denominator is.
What's up?
Zero isn't really anything in the denominator.
So anything over zero is undefined.
Yeah.
Right. So we have, I guess I'm gonna have 4, I got negative 4 over 5, and 7 over 5 as target vector. Now, 0, 10, plus 1. They're going to be trying to communicate.
Yeah, I'll show you this. We will be doing I'll put it, please.
It might be worse with
I didn't put it there.
Do we have to join the Zoom call? No.
No, it's
It's like the outpost.
I think so. And he didn't say anything about leftovers, so I'm just going to say that. He covered, I already had in my undergrad. So.
It's all like legal.
Yes.
It seems very intuitive.
Yes, it is. You know what I did? I actually had my notes, but I meant my notes.
你是封面家，我想买它那个封面。
Yeah. And honestly, that was the best way to review everything because I was they're just like very intuitive, like you said.
It seemed like he didn't go through too much. So like we were. It seemed very slow.
Yeah. But I'm happy that he always reads after
Yes. It's so nice. Right, Charlie?
Yeah.
We finished that class together.
Yeah, that's awesome, yeah. Because usually Thursday I like do more stories.
Yeah.
But
What are you taking next semester?
Good boy.
So I had
Credit risk? With Jose?
oh yeah, yeah.
What's up?
Actually, really good.
You can't get it working? Alright, well, I'll probably put it up, I'll put a place in Husky. If I'm really on my game, I'll put a grade scope. Grade scope is cool. Grade scope will, you would just submit you Black Scholes file. And grade scope will run the tests, and show you grade. Depending on the course, you do again.
We already did it.
Sometimes a limited number of. We can do a screen share this week if you want. It'd be a good thing to, we didn't do it.
Yeah, it's not, I have to take two
Or your truck, you're not bringing your bike anymore.
I gotta get away from
Good, good for you.
It may just be the class that I won't this class.
Yeah, that's why I'm making to learn classes. It's useful.
I think you are.
Part of computer science that a lot of people get to us to just get Yeah, it does, but
Because we paid for.
scaling it to a large scale operation.
Okay.
So actually, I think she might have.
But you know, actually, I think you want to take that class.
It's not that different from Excel. Jupyter does work.
Rather have one class,
Or you
like,
go one step above.
use, you know,
Yes.
like, and
I'll keep on trying.
The reason we
I don't get
took
it.
was so that the computer.
You can text me and,
I think I was
you know,
I'll
right?
give you
I bet you 30 minutes on the phone, share your screen back.
Yeah, I mean, you'd have to pay more, but.
No, I'm still paying for 3 credits,
Right,
yeah.
true.
So it's
I mean, if you make all
That's what you just have to put off the return.
Are you guys happy that you're done?
But
This is.
Yeah, I mean, so the key here, right, for
You know,
instance,
it's until the end of July, so.
Yeah,
I tried to do that.
I'm
well,
glad.
it's like, so the big thing is here.
I'm so glad it's over. Or about to be over.
That's okay.
Yes, but I think I'm gonna. In a month. See what happens.
I think you can actually.
Yes, you gotta click, not, you gotta click in between the line, the number of the line. Sometimes. Now, the first thing that has to happen, has to know these things. Import state time. From the fire, I'm going to show this So this import state, so these are, this is but this says, I'm going to use my own. So when I run this code, it knows this black shoulder.
Reno.
Was it?
So what will happen?
Reno.
Reno?
Like Nevada, nice to meet you, man.
You'll see it goes.
I'm a grad student, man. I'm a grad student. I'm doing econometrics. A lot of math. Not good.
All the numbers.
Very bad.
go back to previous.
I was just interested in it. I'm taking 4 classes this summer, dog. Good. Taking linear algebra, probability theory, differential equations.
Good.
That's what I did my bachelor's in, and I did my first master's in risk management.
Now itself has.
So I'm collecting on like kind of, that's what I'm doing.
Are you working full time?
No, I can't, bro. There's no chance.
Why?
This is another advantage.
Bro, now I'm doing, I have class from 9 to 11 in the morning, and then from 12 to 2, from Monday to Thursday. And then on Wednesdays I come here. Yeah, I worked as an analyst for a not-for-profit for the, I live in New York, so I worked in the city. And it was, yeah, I got money, but that was it. That's about it.
Now I come back here.
How about you? Are you a grad student? And this is for. Oh, okay. Yeah.
UConn as well, or?
No, I did my undergrad at it was at St. John's.
Yeah, I know St. John.
Yeah, it was a decent basketball team. That's about it. Much better one here though.
This cell, which
But yeah, so I did that, and then yeah, I just needed to brush up on my math, dude. Like, and everyone says that if you major in like finance or economics, like, you're just gonna brush up on your math.
So you did the economics there?
Yeah, bro, I was such an idiot. They're like recommended preparation. They're like linear algebra was multivariable calculus and like a few programming courses. I didn't take any of those. Yeah, fucking
looks like S.
so I survived, but like I wouldn't do it unless you really know your math. Like it's really. Because now, like, I wish I could take the classes again, knowing what I know now. But
Yeah, by September.
I'm not gonna do that. So, how about you? What was your major?
Now starting for.
Oh, okay. Did you take a lot of math or
This is
not too much yet?
Right,
Right, yeah. Like, if I could do it again, I'd do stats, bro. You know what I mean? So. Oh yeah, they're all in the same boat. Yeah. Like I wish I knew it earlier, but do the math, bro. Dude, I'm taking, bro. I kid you not. By the end of this summer, I'll have a minor in math. That's how much shit I'm doing. I know. I'm like 4 years too late.
I promise you you're not.
Bro, what was your undergrad? Okay, I did econ and philosophy, so like. Oh no, yeah. Bro, like, I mean, that's fair.
And I had enough credits from UCLA to do it. So I did it. And then I always liked finance, so I joined the program.
Right, yeah.
This program is good, and then I learned a lot, like very fast in this program.
Yeah, you have to.
This one is
like now I'm considering like I have like an opportunity to join a PhD program with
In what?
applied math.
Oh, we're at here?
No, Old Dominion. So
Okay.
we have to do a capstone in this program.
Is that like a final project?
Yeah, something like that. So, one of like the fixed income and the risk modeling professor here.
Yeah.
Connected
Well, you know, it does,
and a buddy.
you know, and if you ask it
Professor that
again,
he's friends
you
with
might get it right the second
That's
time.
great.
After you're an informed user.
And-
Do you think
Now
of doing
what
it?
I've done- so
Yeah.
what's going on?
And when would
in
that
these
start?
methods, right?
Um,
This thing,
one of the students
when you
in this
call
program
this
is
method,
joining in the
you just
spring,
get
and
back
I'm
in the answer.
gonna join in
The
the
common
fall.
thing
and I'm
we
You're
do
gonna join
with
this
that
spring
is-
to give you some time to.
Yeah, the point yeah, exactly.
It's
So,
either
Right, yeah, yeah,
I'm doing a lot of like,
And then this thing is a.
Are you taking a course or are you just self-studying?
Which is the sort almost.
I can
equal
send you,
way
I've been
versus-
taking notes for like a year now.
It's this.
Yeah,
It's the
I'll
absolute value.
I have it in a
And it
Google
says,
Drive,
you
I have
know,
everything.
within 14 minutes, you go.
yeah, I mean,
So of course,
that's why I.
Well,
like
this
the
one
variable
true.
linear.
You know, we're not gonna do it.
Yeah, I mean, right now, the most important, it depends what you want to go into. I mean, doing applied math, obviously linear algebra, ODEs, PDEs, so partial differential equations is huge.
That's what our
Um,
capstone is on.
okay.
But,
One more thing. Did you have to have any math requirement to join the masters?
no.
That's
Except
well,
everyone here.
I know that was like the thing. Like I was looking at,
Well, we could do
well,
it.
like not federal programs, but like
You can send me.
No, there's-
Cloud share.
they all require
Yes.
like a match
Yes.
thing, and it makes sense
What
because
grade are you in?
what's up?
Are you a junior, senior?
No, I'm a graduate in econometrics
Oh.
and quantitative economics. Yeah, this I don't need to be here.
Well, you can see
I'm just here.
what you get
I'm
at the end.
interested.
How do you like that program?
Yeah, it's
No,
a
you
lot
test
of like
Test-
statistical modeling with
Yeah.
econometrics. Like,
A bunch.
because this, I don't know what the required classes are for your program. Maybe they overlap, but for ours, like, so next semester,
No, no,
I'm taking
test-
it's machine learning.
we'll have a
for
class.
Economists,
Instead of having a test.
deep learning, financial
Okay.
econometrics, and then this semester I took convex optimization, which is actually another math topic.
That's, yeah.
$40, that's a lot.
So, but
That's way better than this, I promise.
But here's the thing though, if like you take some of the courses like for it was hilarious for last semester for optimization, he was like the only prerequisite you need is a mathematical maturity. Like, all right, bro, shut up. Bro, we went in there like literally within 30 minutes we're working on like reduced echelon form with matrices. Like, bro, like so you have to know like linear algebra, like yeah. But it's good though.
I promise you,
It's good.
you can learn it very quickly. Like obviously you can't, like the intuition you have to like.
That's the thing. Intuition takes years.
That takes years.
And that's what they're looking for.
Yeah. But like look at like it's like I'm doing. I'm like.
You can do it.
I have an opportunity to.
That's crazy, bro. That's awesome.
So like, you're never too late.
Yeah, no. We're all still super
Also, I
young.
think you picked the better track.
Well, I was looking at programs, and I was like the one thing, if I could get into like applied math up at stores with having applied math masters, I would do that, but I can't. So I have to get into something that's as close to that as possible without needing the prerequisites.
Yes,
so here I am. But now, like I was telling you, how like, what is it, Saeed? Like now, this summer I'm taking 3 math courses, just to like catch up. I am now where I should have been when I was a junior.
I'll get your info after class with you.
Yeah, I could share you a bunch of stuff. So.
Cool.
I'm so good for tomorrow. I'm staying positive.
Have you tried this pie chart stuff yet? Yeah, I can't get pie chart. I was just talking to him about it.
But you can though.
What?
You have to alter the record a little bit, but like.
Yeah, the return. You gotta put the stuff in the return.
What? What do you use? VS Code? Jupyter? Yep.
Wow.
Yeah, man. I'll get your emails. Let me get them now. Yeah, I called you both. I think I no, I didn't mention it. Oh yeah, I'm taking this FR3. Taking it on.
He's a fascinating guy.
Okay.
No.
That's what I heard.
He's that kind of.
Like, bro, like, carry something? Yeah, you're just putting it on. Yeah, it could be. Yeah, I wish I could. Not especially took time series, I'll still do mine, which is kind of what I do. Well, a few classes, but I wanted to have it so that. I would have taken it, but I had too much. I'm graduating in the fall. So I only have this last semester, that's why I wanted to take so many courses.
What are you looking to do after this? Do you want to focus your finance?
No, I wanted to go into, well, the large one's my PhD stack.
Oh, okay. I'm very blessed.
So, yeah, so I have to get some, I know it's
If you like, if you like over the semester, if you can potentially do both.
yeah.
Because he'll definitely pull you over. No, I'm saying to do it like a research project just because it's.
Right, yeah, but I already have a few other professors.
It's only bio, right?
But,
Like the for the research
biology.
It's like it's a bio based.
Oh, my research. Oh, no, it's on finance. But, you know, it's like super, like, elementary, like,
Wages, labor force.
yeah, like how education
That's when I was looking at the programs, I read a lot more applicable to anything, which was way better and like a lot more math, which I wanted to do. But the applied sense of it, that's what I didn't like. These guys like doing like how this affects this, like it's not really like.
And here's the thing too, like, for last semester we were taking applied econometrics 2, it's a 2 series course. You know, it's supposed to be calculus, really not just.
Yeah, I had an undergrad.
Yeah, super good, super chill guy. He's been quiet, but super chill guy. He was supposed to teach this, but he was on leave. So we had an applied course. But he brought sugar.
No, that's for not special.
She is like econometrics. She's all by his national
Yeah.
It's all stats. I mean, like, and you know, she tried her best. Like,
What is it, like T-test and over, like?
yeah, it's on this one's like econometrics. We did like big data. We did like lasso. Regression. It's super good. Super
Bridge
good.
is a powerful tool. People underestimate.
Still don't really know. Like I know how to use it like in R. I don't know how to derive it from the.
Are they, is a lot of them like coding done in R, is it like?
My coding class is for most. I think it's interchangeable. For me, it's mostly R. But for the actual, but for applied econometrics, to handle econometrics, it was not in state. Which is terrible. Because when you have the Fed,
So bad. In undergrad, we were doing that too.
It's the worst. I absolutely hate it. Because no one uses it outside.
It's like 1980s, like, this is just absolutely going on. Sure.
Well, it's because it's super easy. Like my sister did it. She's doing that.
Yes, well, like, at the same time, it really depends when things start working.
Yeah, it's not MATLAB's great.
You can do MATLAB at your job and like nobody will like argue with you.
So do you like train it from New York or?
No, I drive here. It's actually not too bad, 'cause I'm right by the bridge, and like, I'm in Queens, close to the Bronx.
Where in Queens?
Bayside, like,
I grew up in Forest Hills.
oh, you're right there. Yeah, no doubt.
Yeah.
You're exactly right.
I was there for like West Harvard. I live in West Harvard.
Oh, okay, yeah.
2
Oh,
hours.
you're from here.
Yeah.
Is this closer than Harvard?
No, the Harvard campus, they stopped doing classes for this program.
Oh.
I think it's just because like the amount of international students is like half. So like, I don't know, they're not really too.
I get that.
Yes.
I
You pick.
think it's one goal, it's really only useful, like, when you first start. I know it's super easy, I like get discouraged, like, I really want to apply to financial math, because then I'm financial math program at stores.
Financial math?
No, applied math. It's great, yeah, it's and it's great, you can have like stochastic courses, like yield curve courses, right? But you need all the math. Yeah, there it is. That's stores though, it's only at stores.
That is. They never offer you
You can take like a bunch of electives. Some of the electives I take. No, trust me, it's only like 4 students in there. No, trust me, bro, that's why.
Wait, what's your name again? You said you have me on LinkedIn.
Yeah, it's a Reno RISO.
Wait, what's it called? No, that's not here. Do I have Reno what?
CATTA. So it's RI. Yeah.
Yes, I did.
Yeah. So, kind of jealous.
I went to St. John's.
Yeah, 2 T's.
Oh, wow. So you got a master's there too?
Yeah, I got a master's. That degree was so bad. It was just, I don't remember what I did. I did like learn some bar, and I did this class, I had an honors class there. But,
Actually, I think we have one.
We walked.
oh, I mean, for this program.
Yeah, we're done.
We like technically already here at graduation walk. Like we're done after this semester, which is, I guess, important.
Oh, you're done in the summer?
Yeah.
Oh, this year at the town.
Yeah, we do like they have like an accelerated program where like you can get it in 1 year. So we.
Oh, yeah, 4+1.
Yeah.
What's up?
Course was.
What is it? You know what's funny?
I wouldn't usually worry about the math requirements. They would take any, and I think, I mean, you're doing like all of this right now, you're kind of fine regardless, but I would actually look into a PhD.
Well, it's hard. This is the political science. And then you start to ask him, he has a PhD, but you go to, because I have to, right here. Yeah, the guy's teaching us, I had to go to all, I had, because he went to Rutgers, and like, he took like all the senior level math, then he applied to in that, so he got his thing, yeah,
That's what I'm telling you.
but it's not.
It is a grind, and self-studying is going to be brutal for me.
Okay, do that. What do you use to self-study like courses?
So Udemy is a phenomenal platform. It's expensive, but it's worth it. If you buy like the yearly version, it's $250 a year, but you get access to like every course, and they have like everything. But the problem is that it's not like advanced enough. Like they don't have like real, like, I guess like the first
analysis.
Like no real analysis. Like the first program, the first like
This program's probably like 2 years now.
yeah, the first course for the PhD program is real analysis, and that is like absolutely brutal, because that is like the first time we have to start thinking like a mathematician.
I always say like real analysis is
Yes, exactly.
Like your first, like,
And like all the equations, like
you're
probably.
expecting to build number lines.
Yes. And like probabilities like are intuitive to a sense, but then like when you get to like set theory and all that stuff, then like you really need to like understand.
I took that theory in undergrad.
Okay, we'll start again.
Yeah.
Okay, so we're talking about ways to represent to graph the volatility smile. So what we're talking about is a two-dimensional graph where on the y-axis we have the sigma, and on the x-axis we have some variable. Pretty common to use delta, and we actually might want to put 25 delta put here, and 25 delta call here. And then this could be at the money, which might be approximately 50 delta, but not exactly. And then, because of the way I've set this up, I've chosen that I'm going to represent sigma as a function of delta. So looking at the FX smile that we saw earlier, might be the case that in better days when volatility was more exciting in foreign exchange, the at the money delta might be, let's change that. Might be 10%. And in case of the smile, we might have the 25 delta options at 12%, so we get this picture. So this would be the sigma implied smile. And as I mentioned earlier, the reason why I put 25 delta here for puts and 25 delta here for calls, I could also, I suppose, let's see, 25 delta. So these are, this is the, so let's just say spot is equal to 100. So the call strike might be, so the call is going to be out of the money, right? So if the spot's at 100, a call strike would be some number like, I'll put a question mark on this just to say, 110, or 120, 105. And similarly, the put strike, to be out of the money, the strike would be, 95 or 90 or 80. And which of these numbers might be the actual number is a function of the time to maturity. And that's the one missing piece in this. I'm taking a picture of 25 delta options on the upside and on the downside without reference to what tenor is the word we use, T-E-N-O-R, time to maturity. And common tenors in volatility markets are similar to common tenors in interest rate markets, although interest rate markets go out a lot farther than volatility markets. But volatility option, FX options might be commonly traded 1 day, 1 week, 1 month, or 2 weeks, 3 weeks, 1 month, 2 months, 3 months, pretty much out to a year, and then 2 years, 3 years. But one of the things about foreign exchange is that the market is so deep and so liquid, especially in the major currency pairs, that you can trade pretty much any strike for any day, and some large bank will quote you an option price. Whereas if you've ever looked at equity option markets, you see that strikes are typically like only every five. If it's a $100 stock, strikes will be in increments of $5. 105, 110, 120, and so on. And similarly, we'll look at. I'll bring up a volatility shot from the Chicago Mercantile Exchange for natural gas options or oil options. We'll see they also have sort of like this fixed layer of strikes. But FX is sort of the ideal market for trading anything because it's so deep that you can buy a $10 million option on euro. $10 million is nothing in the currency market, right? Because currencies trade trillions of dollars a day. I think that's accurate. And as we discussed, for an option to be out of the money when there's a lot of time to maturity, it has to be way out of the money. Like, can I go from 100 to 105 in a week? Probably, right? Can I go from 100 to 120 in a week if vol is only about 10? Well, let's think about it. 10% per annum kind of says that, roughly speaking, we'll put this 100 a little stronger. 10% of 100, is $10, right? Is equal to, let's put a dot on top of this. I'll explain why. 1 standard deviation, right? So by our normal thinking about returns, right? We know that if we're at 100, and the standard deviation is at 10, we think we're almost certainly going to end up between 70 and 130. And this is only if we have a whole year, right? Because 10% is the annualized vol. So something was trading at 100, and an example of a currency that trades around 100 would be dollar yen. And now it's up pretty high, like 140, 150. But it often migrates back down to 100. It can take a decade, but it gets back there. It goes back up, sometimes goes stronger. Well, all currency pairs tend to oscillate around each other on longer time cycles. Okay? So, if the strike were 120, could you get there in a week? I mean, this says you can't even get there in a year. It's 2 standard deviations. Right? You could, right? To rise to 120, well, this is your 68, 95, 99.7 rule, right? What does that mean? Right? To get to 120, you have to go, 50% that it didn't go down, 34% that it didn't go up, and then you have, up to here. So there's 13% chance that a year from now it'll be in this interval, right? Always good to have that rule of thumb. And I say approximate because these are really, the log normal volatilities that get stuck into the model, the volatility of the returns. And it doesn't exactly translate into, well, maybe it does it, yeah, I guess it sort of does. But yeah, because I'm using 100 as my base, I think we're okay there, okay. But, so it can't get there in a week, but, can it get to 105? Yes, it could, right? So that could conceivably, even 105 is a big move on 10% volatility, right? Because what's the 1 week distribution of prices, right? We talked about this, right? Using the square root of time, right? For a 1 week option, let me get rid of that. What's the sigma for 1 week? How is it related to the sigma for 1 year? And by this, I don't mean the expiration is 1 week versus the expiration is 1 year. I say if it's going to move sigma annualized in a week, how much will it move in a year? And the answer is, well, we know that sigma, we'd have to multiply, how many weeks are there in a year? We want to multiply by the square root of 52, is that what I want? I believe so. Yeah, right? But that means that the sigma on the 1 week option is the sigma on the annualized option divided by the square root of 52. So given that we had 10% square root of 52, let's just call that 7.1%, let's say, right? I'm sorry, divided by 7.1 is going to be equal to, I don't know, 1.4%, give or take. So if we expect, maybe the standardized move to be 10% in a year, we're saying it's about 1% in a week, right? Yes.
This might be semantics, but when you're doing 52 for 52 weeks in a year.
Right.
And when you do daily, you do 252 days for the
Mhm.
trading days. So why wouldn't it be adjusted for 252 trading days? I don't know if that.
Well, because it would still be, there would be 5 in a week over 252, right? That's going to be, or 252 over 5, right?
Sure.
Basically. I mean, there's slightly more than 52 weeks in a year, right?
Yeah.
It's 52.1428571,
Yeah.
right? But we could think of it as being, the sigma of 1 week scaled up by the square root of 252 over 7 would be the sigma annualized. Yeah. So, the probability of getting to even 105 would be pretty small. We're really saying it's only 1%. So one standard deviation in a week would get you to like 101, 2 standard deviations would get you 102. So these become out of the money options pretty quickly. But forget about the time, the statement here is that if you trade an at the money option, whatever the tenor is that we're talking about, I'll stick the 10% vol into the Black-Scholes model, and that's how much I'll charge you. But if you want to buy a 25 delta call or a 25 delta put, in this case, I'm going to charge you 12%. And because of the monotonicity of option prices as a function of vol, 12% options are more expensive than 10% options. But the strikes are worse, right? So this won't be a more expensive option than an at-the-money option because its strike is so much worse. But the volatility at 12 will make it more valuable than if you had stuck 10 as the volatility. And one of the first things about arbitrage, right, is there's no way that this call could be more expensive than this call because this call is going to this call will be in the money long before the 25 delta call was in the money. You get paid off a lot better, right? So you obviously have to pay more for the at-the-money option. You just don't have to pay more in implied volatility terms. So in a way, when you're buying a 25 delta option, what you're saying is, and it's actually a decent proxy. It's not perfect. You should be aware that it's a good rule of thumb. If someone says 25 delta call option, what's the probability that it finishes in the money? It's good for you to say, it's about 25% probability. But it's also good for you to know, but it's not exactly a probability. ND1 is not a probability of being in the money. ND2 is actually the probability of being in the money. What's the difference between ND1 and ND2? Well, let's take a quick look, right? You know, ND1, right? And versus ND2, right? Well, ND2 is just N times D1 plus sigma root T, right? It's just a little bit bigger. What does that mean? D2 versus D1, you know, D1 is some number, like over here, right? D2 is going to be some other number over here. Let's just take in a case of the at-the-money option, right? At-the-money option, what is D1 going to be? It's going to be equal to the log of F over K plus 1/2 sigma squared T over sigma root T. For my taste, it's good to think of at-the-money means that the strike is equal to the forward. The geometric variety motion is set up so that if you start your asset at time 0 at this location, let's say spot is equal to 100, the Monte Carlo simulation, which we'll learn about later this summer, does not aim for 100. The drift forces the average of the Monte Carlo to go to wherever the forward is. So at the money option says, a year from now, my simulation or my probabilistic math will land on the forward, not on the spot, on average. And the distribution is centered on F, not on S. And the returns are around F. Sigma, F plus sigma times S basically is one standard deviation, okay? So what happens, what happens to D1 when F and K are the same? This is where you want math, right? F and K are the same, so what's F over K?
1.
Log of 1? Log of 1 is 0. Right? What does it mean? Log of 1 is 1, right? Log of 1 equals, let's call it y, right? Log is just another way of writing the log to the base e of 1 is equal to y. So e to the y equals 1. What does y have to be? Y has to be 0, right? And that shows up in the graph of the exponential. X is 0, y is 1. The graph of the log, which is its inverse, x is 1, y is 0. And it doesn't matter what the base is. Every base logarithm goes through 0, 1, because any number to the 0 power is 1. Every log goes through 1, 0, because just writing it backwards, everything to the 0 power is still 1, right? So F over K is 1, means that this thing is 0. So we end up with this ratio, it's just sigma root T over 2. So how big is sigma root T over 2? This is where you start to develop them. Let me have some sense of what numbers are involved here. And we know that, let's just use equity as our example, or in our case, we had FX, we said sigma was 10%. Equity sigma, let's say, is 20%, right? So let's say T is 1 year, because otherwise it'll be even smaller. So if T is 1 year and it's equity, 20%. So 20% times 1 year is 20%, divided by 2 is only 10%, right? So D1 will be equal to, what do we say? It's going to be 20% over 2, which is 10%. What will D2 be? D2 will just be equal to D1, which is 10%, plus another 10%, which is like, okay, so that's 20%. So So in this particular special case, D1 is 10%, D2 is 20%. Twice as big seems like a lot, right? However, what does this mean in terms of probability, right? Here's my ND1. This is 10% of 0.1. This is only 0.2. Keep in mind, I'm talking about a normal distribution, right? So what I want to know is, like, what's this probability? When I say how much area has been accomplished, right? We got 50% here, right? And we went 1/10 of the way to 1 standard deviation. So a whole standard deviation, this is sigma equals 1, would get us another 34%. So a 1/10 of the standard deviation would be about 3.4%. This would be about 6.8%. It's slightly, not quite that much, because there's more mass here, because the curve is fatter at the top than it is at the right side of the distribution. So you can see, if ND1 happened to be 53, let's say ND1 is 53% in this case, ND2 would be about 56%. So you see, if you said that ND1 was the probability of being in the money, you'd say, well, that's like 53%. Well, you'd be off by 3%, which, all things being equal, you're just eyeballing it, you're just making a number up by that. It's not a bad estimate, right? Okay? And in fact, if it wasn't a year, if it was only like a half a year, let's say it was a quarter of a year, then this whole estimate would be off by a half, and it will only be 51 versus, say, 52. So my point is that what is delta, which is ND1, don't forget there's also e to the minus qt, the discount factor, right? What is delta? It's about the probability that you finish in the money. The real probability in the risk-neutral model that is the Black-Scholes formula is ND2. So it's good for you to know that ND1, delta is a good proxy, but it's not exactly right, because it's not really ND1, it's really ND2. Now, why do you want this? Why do I talk to you like this, right? Well, because you're going to be dealing with market situations, and you're going to want to be thinking, what's going on here, right? I want to have an idea, and you have a pretty good idea. It's not a bad guess that at the money options are 50% likely to finish in the money, especially if you say that your model has this. Well, first of all, don't forget, we're drifting towards the forward. We're not drifting towards the spot. So we're saying the model, roughly speaking, 50% likely to end up above the forward, 50% likely to end up below the forward. If it were normal, it would be the mean, and the median would be the same, and the mode. But if it's log normal, it's not exactly the same. Mean, median, and mode, you understand those, right? Normal distribution, they're all the same, right? The mode, which is the high spot, is the same as the mean, which is 50 on the left, 50 on the right. I'm sorry, that's the median, 50 on the left, 50 on the right, is the mean, which is the weighted average of all the numbers, right? But by being self-aware is to understand. So saying ND1, which is delta, is the probability. That's a good answer, right? You understand that it is related to probability, but not forgetting that the real probability is ND2, because then somebody will think they're smarter than you because they know that and you don't know that. And when you go to an interview, most interviews, they only ask you questions they know the answer to. They don't know if you know the answer, but they're not asking you stuff they don't know. They ask you stuff, that's how the interviewer gets to feel smarter, right? I mean, I'm smarter on this set of questions that I'm asking, because these are ones I know. And the trick when you're getting ready for an interview, right, is let me see if I can know all the stuff that they might ask you. At least as much as I can. But other interviews depends, right? They're also going to be interested in how does this person respond when they don't know the answer, right? And what is their thinking process? What facts are they able to extract from various parts of their background in order to answer questions that they don't know, right? Okay. So we have a delta smile, right? Okay. Similarly, let's put a skew up here, because it gets more interesting with skew. The next concept I'm going to discuss. And actually, in foreign exchange, a common currency pair with an interesting skew is dollar Brazil, which is equal to the price of 1 USD in BRL. And actually, it's pretty common to not include the slash here. It just gives the 6 letters. Often it will just be called, since the dollar is the most commonly traded currency pair, often they'll just say BRL. And it's under, like if you go to Bloomberg, BRL equals will be dollar Brazil equals. But if you want to specify Euro Brazil, you gotta give the other pair. Sometimes they'll give both pairs. Okay, it's the price, and so you can see how foreign currencies are quoted. The first 3 letters are the currency you're buying. The second 3 letters are the currency you're paying with. So that number, which is like 4 or 5 right now, I haven't looked at it in a while, is 4 Brazilian reais buy you 1 US dollar. Okay? You could quote it the other way, BRL USD. If you're a Brazilian bank, for example, you might think of it that way because it's denominated in your currency. And then the quotation would be 0.25. It takes 25 US cents to buy 1 Brazilian reals. Obviously the same thing, but you just need to be aware of the convention. Okay, so now dollar Brazil, as we talked about first, we talked about this actually in the fall, I think, too. As we talked about, the skew in dollar Brazil tends to look like this. So unlike equity skews, where it doesn't always have this little uptick at the end, foreign exchange pairs, even when they're skewed, will typically have a smiley component as well as a skew component. And again, the reason for this, so what are we quoting here? So this is the dollar Brazil exchange rate. So this is the exchange rate, which I'm going to denote by, well, you know, I'm just going to look it up right now. I've got my computer handy so we can frame our discussions in context of 2025, USD, BRL, 5.54, okay? So right now it's 5.54. Okay, that's the spot. As we say, options really are centered on the forward. In fact, in dollar Brazil, you can't really trade the spot. Brazil is an example of a currency with a country with tight currency regulations. Not any old person can just buy Brazilian reais and sell them. You have to have a license to trade Brazilian currency, and that means you typically have to be like a Citibank or someone similar to that, who operates both in Brazil and offshore Brazil. And they are permitted to exchange. Brazil is an example. Trading dollar Brazil is an example. What's called an NDF, a non-deliverable forward, which means if I am a U.S. hedge fund who wants to speculate on dollar Brazil, or if I am a U.S. corporation who wants to hedge my exposure to dollar Brazil in the over-the-counter market. Over-the-counter just means by trading with banks. I have to trade in the NDF market. NDF stands for non-deliverable forward. Any currency pair that's not an NDF, so it's a deliverable forward, that means that if I buy euros for the future, when that day comes, you will put euros in my European bank, and I will put dollars in your U.S. bank, and we'll be set. And actually, what happens the night before the money is supposed to flow, the system will check that Ed Hayes has put his dollars in escrow for J.P. Morgan to grab in the morning, and J.P. Morgan has put euros in my Frankfurt bank or my Paris bank, SocGen, let's say, so that, and when 5 o'clock happens in New York time, it simultaneously transfers. This is the SWIFT system, essentially. Okay? But non-deliverable forwards mean that if I bought dollar Brazil for 1 year forward a year ago, what will happen is 2 days prior, like today, there's a process in Brazil, in Rio de Janeiro, I suppose, where they agree today's price for dollar Brazil is 5.54, if that's the number I put up there. And what that means is that people who are trading Brazil onshore who have the license to trade dollars in Brazil onshore will exchange 5.54 raise for $1 today, settles in 2 days. A lot of FX settles in 2 days. And my NDF will settle against that number, but get converted back into dollars. So if I traded with Citigroup, they will, let's say I bought dollars at $4 raise for $1 a year ago, and now it's 5.54. So I've made 1.54 raise of profit times, let's say, $1 million. So I'd have 1.5 million raise in profit, which get converted back into dollars by dividing by 5.54. So that'd be whatever, $200,000, $300,000, whatever it is, right? And those dollars would land in me and Citibank would settle up in US. They'd either send me dollars or I'd send them dollars depending on the contract. Now, of course, I could refuse to send them dollars, in which case I'd be in default. Citibank would go after me, right? But Citibank would not have issued me credit if they didn't think I was the worthy counterparty. Other examples of NDFs include the renminbi, Chinese yuan, not sure these days. Taiwan dollar, for example. Singapore, I believe, is deliverable. Thai baht, probably non-deliverable. Indian rupee, I believe, is NDF. Okay, so the skew here, right? So this is saying, let's just say these are 1 year Brazil options, right? It might be the case that the at-the-money vol, I might even be able to get this off the internet, probably. If I had a Bloomberg term, I'd get 1 year vol. 1 year vol in Brazil. Now this is like NYU has this Garch volatility analysis. That's kind of nice. But well, it tells me 1 year prediction is 14.56. But if let's just say the predicted vol, sigma predicted in the Garch model is 15%. Sigma might trade at, let's say, 18%. It's usually the case, not always, but it's usually the case that implied volatilities, this is my sigma implied volatilities tend to be higher than expected realized volatilities or recent realized volatilities. There's no hard and fast rule on that. Implied volatility really just indicates how much someone's willing to pay for an option. So it could be $1 million or it could be 0 if people aren't paying. But typically they'll kind of follow. And what's the prediction? It's using a Garch model, so it's basically taking some weighted average of the history, right? And you did the Garch models last semester, right? Yeah. And if people are, first of all, what happens is if volatility is realizing to be your low numbers move along, people who own options suffer pain because they're not getting the gamma that they need to make money, and consequently they will start to sell their options, which will put downward pressure. And other people will say, well, it used to be 20, it used to move at 20% a year, but now it's only moved 15% a year, so I'm going to pay less. When it was 20, maybe I was paying 23 for an option. Now it's 15, I'm only going to pay 18 or some premium. Okay? And why do you have the premium? Well, there are different reasons. One of which is that I don't know what the I'll leave that alone for a second. But you can see from the skew here, what we're saying is that the 25% downside option, let's just say that's here, might be at 20%, and the 25% upside, the 25 delta call might be at 24%. Okay, so let's just say this is the call delta equals 25, and then the put delta equals 25. Okay, so what did we just build? We just built the following little table. We said the delta, and we said the implied vol. And we're going to put them in order as 25 delta put, and then at the money, and then 25 delta call. Okay, so we just said now that the at the money was 18%. Hold on a second. The put was 20%, and so what we've created is that in this particular market, both puts and calls are more expensive than at the money options, expensive in volatility terms, okay? And puts are relatively cheaper than calls. Out of the money puts are only 20, whereas out of the money calls are 25. And these three numbers are part of a famous relationship, two famous relationships actually. First one is called the risk reversal. The risk reversal, so what is a risk reversal? And why is it called that? For our purposes, is equal to, let's call it the RR, is equal to the sigma of the 25 delta call minus the sigma of the 25 delta put. Okay? That's what I'm calling the risk reversal. It doesn't have to, this is the 25 delta risk reversal. You could have the 10 delta, and in fact, a common other instrument to trade would be the 10 delta risk reversal. We'll talk about that in a second. Okay? So in this case, it's equal to 25% minus 20%, or 5%, or we might just say 5 vols. So when people say 5 vols, they mean 5 volatility points, or just 5%. Okay. So we've got, at this point, in currency markets definitely, but also I'm sure in other markets, we've got a tradable, we got another tradable. We can trade the risk reversal, which is to buy the upside and sell the downside, or vice versa. And then you're speculating that whatever else happens in the world, if you're long the risk reversal, you're expecting that the spread will widen to 27 minus 20, let's say. If you're short the risk reversal, you're speculating that it will narrow. You're also saying that I think the market's forecast for the fat right tail is more accurate than the market's forecast for the fat left tail, or in the case of equities, the not fat at all right tail. Okay, that's the speculation there. And we get a second number, the so-called, let me see what Hull calls it before I give it a name here. I don't know if he gives it a name, actually. I think he does. I'm going to call it the, we often call it the butterfly. But a better name might be the, yeah, I guess a butterfly is good. And the definition of the butterfly, which is just often called the fly, is equal to, you take the sigma of the call, 25 delta, and you add to it the sigma of the put, 25 delta, and you subtract 2 times the sigma of the at the money delta, and then we divide by 2. So another way to put that is the, well, let's just leave it at that. Okay. So in this case, the call is 25 vol, the put is 20 vol, and then 2 times the at is 2 times 18 vol, and then all divided by 2. That gives me 45 minus 18 times 2. So that gives me 4.5%, or again, 4.5 vols. So in this particular example, I think I'll just, oops. So in this particular example, let me pull this thing down a little bit. Okay, we see that for the table that I've given, the risk reversal is 5 vols. And the strangle is, the butterfly is 4.5 vols. So this is, now we've got 3 characteristics of this market, which isn't surprising. We start with 3 options. We've got a overall opinion about the level of volatility that dollar Brazil market's going to experience is 18 over the next 1 year, let's say. Okay, but we've also got an opinion about the relative value of upside options versus downside options. Upside options are 5 vols more expensive. And we've also got an opinion about the value of the kurtosis, the fat tails. The average premium over the at the money is 4.5 vols, right? Because we see that 25 minus 18 is a 7 vol premium, and 20 minus 18 is a 2 vol premium. So the tails in some way are worth 4.5 vols, at least in the opinion of the market. Remember, implied volatility means that this is, in theory, where these options are trading today, or where they traded today. You come in tomorrow, they'll have different opinions, right? If the world comes to think that the dollar is at risk against the Brazilian currency, or let's put it differently. Typically, the reason why the skew is what it is, there's always the risk that, the old saying, the United States gets a cold, Brazil gets the flu, let's say, economically. Now, when things are going smoothly, because the Brazilian economy is smaller and potentially more dynamic, people want to put their money into Brazil because they think it's going to grow faster. The old BRICS story, right? Brazil, Russia, India, China, right? Is that these are economies that are more in flux, more dynamic, and there's lots of opportunities for excessive growth. Think about China GDP 5, 6, 7%. When G10, U.S. GDP is 2 or 3%. Euro GDP 1%. Right? These are growth opportunities. But when economies dry up, specifically the biggest economy, the United States, becomes in trouble, that potentially causes trouble to other economies who are reliant on sending goods to the United States or investment from the United States, right? So if the world starts to think, hey, the world is a safer place for emerging economy like Brazil, maybe that risk reversal will shrink. Instead of being 25 minus 20, maybe it'll be 23 minus 20, right? But right now, because there's definitely a lot of economic uncertainty as to what the next year is going to look like in terms of tariffs, policies, and the like, right? This will be a situation where we do expect that the tails are fatter. We don't know. The world might go crazy up or go crazy down. We don't know which way it's going to go. If everything gets really smoothed out and things start functioning really well, that might be considered bullish for the world, which means that there's going to be a lot of GDP higher than expected, which kind of shows up in a right tail. But if the world is worse than expected, that shows up in a bad left tail. If both things are possible, you get this symmetric sense of make this thing a larger number. 4 volatility is a pretty big tail skew, kurtosis risk. And if the world looks bullish, probably the risk reversal comes in. Brazil becomes a little bit more, the downside protection becomes a little more unnecessary. Keep in mind, what does downside protection mean here? What we're saying is that, looking back at this picture, well, let's look at the distribution of returns. We take using the graph from before, I guess normal distribution looks like this, using the graph of the S&P, but translated to here, we'd say it kind of looks like this. Let's see. The risk is that okay, this tail is meant to be fatter. Let me get rid of that second one. There's a little bit of fatness in the left tail. And what does left tail represent here? So this is the exchange rate, right? Which is the dollar Brazil, excuse me, is equal to 5.56. So this is a higher probability than expected that we get to 6.5, let's say, and a slightly higher probability that we get to 4.5. But this represents you need more Brazilian real to buy US dollars. So it's Brazil weaker, dollar stronger. And this is the other way around, dollar weaker, Brazil stronger. Okay? And both of which are considered more probable than the normal distribution implied. But the skew is over here. And it's just, this is the way it is. The dollar yen, this pink graph will be flipped. It's often been the case that it goes the other way. Okay? So now we have the following situation. So we come up with the risk reversal is equal to the delta of the call minus the delta of the put. And we said the butterfly is the delta of the call plus the delta of the put. And I'm going to put that over 2. And I'll add I'll subtract the at the money. Well, these are the sigmas, okay? I didn't write the sigma every time here. And I've just taken the formula for the butterfly and I split the 2 terms in the numerator like this. So now you see now what will happen is you've got 2 unknown, let's suppose the risk reversal and the butterfly. So in foreign exchange markets, for sure, it's common to trade these 3 items separately. And I guess, do we need that's all we need. And we know the at the money volatility. Okay? So if you call up an FX dealer and you say to him or her, you say, well, you don't call him up anymore, you signal his system or her system electronically, and you say, where are the at the money, where's at the money Brazil? And they say, oh, it's 18. And I say, okay, well, what's the risk reversal right now? Risk reversal is 5. All right, what about the butterfly? Yeah, butterfly is 4.5. All right, so now I have a picture of 1 tenor. Keep in mind, this is only the 1-year tenor. Could be different numbers for 1 month, 2 months, 6 months, and so on. I have those 3 numbers. What vols are implied by those numbers? And we see what we've got here. We said the risk reversal was 5. The butterfly was 4.5. And now this will be, let's call the sigma call minus sigma put. And then over here we have sigma call plus sigma put over 2 minus the at the money. We said the at the money is 18 vols, and I've dropped the percent everywhere. So now you can see what you have is 2 equations in 2 variables, right? Which is mathematical magic because it's probably, these are just lines, right? So we should be able to solve this system of equations. Let's rewrite this as 5 equals sigma c minus sigma p, and let's multiply both sides by 2. 9 equals sigma call plus sigma p plus 36, or minus 36, right? And now what we can do is we can add both equations. We get 14 equals 2 times sigma call. The puts cancel out, minus 36. We put the 36 over here. Right, now we get 25 is the sigma of the call. Right? And then similarly, sigma call minus sigma put equals 5. This is 25 minus this is 5. So the sigma of the put has to be 20, right? So not surprisingly, answers we put in are the answers that come out. Yes?
Just curious, could you put this in, so you could solve by substitution or elimination, but could you put this into a matrix
Sure.
and then solve it? Well, let me ask you, the matrix that you put this in, for you to find the outputs, you would have to get it into like echelon form, or like, is there a way to get the answers from a matrix, or?
Yeah, I mean, so.
You just saw this.
So writing this as a matrix, right, we would have, what would we have here? So the two unknowns are sigma call and sigma put. We want to put the 36 over here.
Right, so you want to get them alone.
Let's do it like this, right? And then what we would just be saying is, and the coefficients are all 1, right?
Right.
So what we would have is, 1, -1, 1, 1. And I'm going to call it the call and the put. It has to equal 5 and 45. That's the matrix
Right.
representation of the same thing, right? Which is just that, the top row times call put equals 5, and then the bottom row times call put, the dot product is 45. Okay? And we can actually see 25 plus 20 is 45, and 25 minus 20 is 5. We can see the answer. And how do you solve a system of equations? That's kind of the subject of half a semester worth of linear algebra. But we could write this as A times sigma equals, let's call this, I suppose we call it n, let's say. And then sigma would be equal to A inverse times n.
Right.
So just like in arithmetic or algebra, I guess, you divide by A on both sides. In linear algebra, you multiply by the inverse of A. Implication is it has to be invertible. Turns out the inverse of A for the 2 by 2 case can be easily written in terms of determinants. The A is equal to what we say? A was 1, -1, 1, 1. A inverse, let's see if I get this right. First of all, these two change places.
1, 1, -1, 1.
I think it's like this, right?
Right, yeah.
And then we have to divide by 1 over the determinant, which is this times that, which is 1
-1?
minus -1. So it's a half. I think that's right.
Minus, yeah. Yeah, you're right.
That's the inverse. And then we want to get the answer. We take 1/2, 1, 1, -1, 1, and multiply it by n, which was 5 and 45. So now we get 1/2. This row times this column is 5 plus 45 is 50. And then this one is 40. And half of that is 25 and 20. And voila.
Right.
Obviously easier just to do the 2 by 2 case by hand. But good to know that this stuff works, right? Good incentive to take a good linear algebra class if you haven't done so yet. You can do linear algebra without doing calculus. If you haven't done calculus, you can actually do linear algebra first. Calculus is probably a little more useful. If you want to go into machine learning, you're definitely going to want linear algebra more. But you really want both, as I've told you. Okay? All right, so what we have, what the FX markets, because of its deep liquidity and large volume across the globe, and long history of people figuring out how to trade them, we have this shorthand for the market where you can describe 3 interesting factors, which is the level of volatility, the second moment, the skew, which is the third moment, represented by the risk reversal. I'll talk about where that name comes from in a second. And the butterfly, which is the fourth moment. So FX options, it's pretty easy to trade directly the risk reversal and the butterfly, and then you're really formulating an opinion on skew and kurtosis, right? So the options market really provides a way to express views about the nature of reality that you just can't get from spot alone. Now, why is this called a risk reversal? I'll show you that. So the risk reversal, basically, notice what we said. So the risk reversal is equal to long the call and short the put. That's why we're doing the subtraction. And what that means is that you're long, let's say, this option, and you're short this option. This is the 25 delta put. This is the 25 delta call. And using social numbers, if we have 100 here, maybe this is 80, and this is 120. They could be anything, right? Again, we talked about this. Depends on the time to maturity, depends on the level of volatility, right? But what happens? This is the payoff diagram at maturity, right? It's a hockey stick up because you own the call. The put would be a hockey stick going the other way, but you're short, so it comes down here, right? But what's the Black-Scholes function going to say? The Black-Scholes function is going to say, this looks like this. This is the value of the call. And then the value of the put looks the same way, except it's going the other direction. I'm going to draw a slightly better version of this. Put it more like here. So notice in the risk reversal scenario, in the middle, between 80 and 120, nobody wins. The call doesn't get to exercise because we're at 100, it's worthless. The put doesn't get to exercise because we're at 80, right? But both sides, but over here, so what happened? Oh yeah, I know what I was going to do. Got stuck for a second. This is the payoff of the put. And this is the Black-Scholes value of the risk reversal. And we talk, this convexity is what volatility gets you. It's the positive gamma. But notice what happens over here. Over here, gamma is positive, and over here, gamma is negative. This is if you own both of these structures. Well, you don't own both. You're long the one, you're short the other. Right? And this means that theta is negative, and here theta is positive. And we talked about what are the risks, right? When you have positive gamma, that is when we're moving towards your strike, right? You want things to happen because positive gamma means that you get to make money on every rebalance. We talked about that. Price goes up, you get to sell. Price goes down, you get to buy. Positive gamma is great. You get to buy low, sell high. Negative gamma, the other side of the option, is the opposite, right? So what happens is when we're above 100, if you own this structure, you're rooting for a lot of activity in the market, which of course makes sense. You also own the 120 strike, right? And you're just hoping we can get to that 120. When we're down here, like if you're at 90, let's say, you don't want any more motion because you're afraid conceptually that you're going to end up having to pay out on the option. So this is why it's called risk reversal. Down here, you want the world to be slow so you can earn the theta. Over here, you want the world to be fast so your gamma will pay for your theta. You've reversed your risk. Below the strike, below the middle there, you want no action. Above the middle, you want action. Another way of understanding why this is called a risk reversal is that this could hedge a forward. So what's the payoff from a forward, right? Forward is just a straight line. So if you were, in this case, short the forward, and this is like who might buy a risk reversal on the corporation side. If I need dollars in the future and I don't have them, right? I'm concerned. So if I'm an investor who has put a lot of money into Brazil, and someday in the future I want to get the money out of Brazil and convert it back into dollars. So I'm short dollars, right? Because I took my dollars, I sent them via Citigroup to some investment in Brazil, or maybe I'm long the Bovespa, the Brazilian stock market, right? But eventually I want to get those things back to dollars because I'm a dollar-based person, right? So I am at that point short dollars and long Brazil, which means if the dollar gets really strong, I got a problem. Even if the Brazilian stock market does great, I got to convert my gains back into dollars, and if the dollar's really strong, that's bad for me because I get fewer dollars back, right? So structurally I got the pink line. I lose money when the dollar gets stronger, and I make money when the dollar gets weaker. If I do a risk reversal, first of all, you can always hedge a forward by doing a forward the other way, right? That's totally neutral. But maybe you don't want to do a forward. You want to do an option. You want to have a little optionality. Why would you want a little option? Well, maybe because you think that the upside is priced cheap by the market relative to the premium they're charging you for the downside. That would be why. Okay, so you do the risk reversal. You try to get a little extra juice out of it. This way, if the dollar rallies, well, your option is going to be going in the money. You may be able to make some money gamma trading. Okay, but notice again, the blue line, which is going up, has reversed the risk of the forward, which is the pink line going down. If you add the blue line and the pink line, not counting the part in the middle, you're roughly around zero. Of course, you're sacrificing the part in the middle here. Okay, and other people will do this, like an oil producer, right? His risk is his position. If you're an oil maker, an oil driller, your position is you're long oil, right? So you might do the trade the opposite way. You'd sell the risk reversal. They call them fences or collars in the commodities market, more often than risk reversal, but I like risk reversal better. Okay? What we'll do next week is I'm going to talk about this equation. This will be the first thing, and then we'll move on to other topics. This is quite a clever formula. So if you look at this formula here, determining the implied distribution for S, so that's page 21. Let's just go back for a second to page 5, I guess. Yeah, so we had this pictures earlier. We had two of these, one for the equity and one for the currency, where the implied volatility, so the log normal volatility, the blue graph, is just the at the money sigma normal distribution. The blue graph is a normal distribution with sigma equal to whatever at the money level we're using. The pink graph is what's called the implied distribution from the skew. Well, it's kind of more interesting with this pink graph is definitely saying option prices say I think there's more of this going to happen than I expect than the at the money involved would imply. And what happens is two guys named Breeden and Litzenberger. I think Litzenberger is still at Goldman Sachs. Actually, let me just. He also wrote a famous book, which is if you're thinking about going into asset management. Litzenberger. Maybe Breeden wrote the book? I'll look it up for you. There were other books. Anyway, Breeden and Litzenberger did the following. They said, look, what's the value of a call option, ultimately? The value of a call option is, it's the discounted value, e to the minus RT, of the payoff. Now, what's the payoff? You get paid, it's a call option, so you have to fork over K dollars, but you receive the value of the asset at maturity, ST. So your payoff is S of T minus K. And that's what you'll make only before I get to the G part, when K goes from as long as S is in the money. So let's say K is 100, you start out S of T is equal to 100 up to infinity. So all the scenarios where we end up with more than 100, you get paid a little bit of money. 101, you get a little, 102, you get a little, 150, you get a lot. But you want to multiply that by the G of S of T, which is the log normal distribution. That's what you're multiplying by. You apply the fundamental theorem of calculus twice, and you come up with a formula which says that the implied density at a given strike is given by this formula. We'll talk about that next week, and that's where that picture comes from. Now, all that really is saying is the following. It's saying, look, even though the Black-Scholes model says the world is blue at the money, the market is willing to pay more There's more density over here than the at-the-money vol is revealing. The at-the-money vol says the density is blue in the tail. The options market willingness to pay says they'll break even if there's this extra fat piece over here in the pink. And it's kind of a nice formula. It's a theoretical result, but it does give you an idea of, you know, if the sigma in the bottom gets bigger, this tail will get fatter. And if the sigma gets smaller, the crash risk is smaller, this will go down. Okay? All right, that's it for this week. Try to get that homework to work. I'll put up a spot in Husky for you to submit it. There's no real hard deadline. You know, you should probably try to finish it by next week. I'll take everything you give me by the end of the semester. As far as midterms go, it'll be a take home at some point. You won't be in class, not taking tests. And I'll give you something to work on. Okay?
The last week's got screwed up
No.
because it was.
File still good.
Yeah, but it was too big for YouTube because for some reason it did 240 frames per second. So it was 100 gigabyte file, but it's trying to say it's 17 hours long, and YouTube is saying. So I'm gonna try at some point to do a.
Yeah, bro. I'll send you guys the airdrop.
I'm gonna try to do a screen grab of it, just playing it for now 3 hours. So we're long. This one I